out, but we'll go back if there's any interesting questioning coming up. But right now, let's kind of reset here, get a sense of where we are in the market with Nathan Hager down in Washington, D.C.
I don't know. It's a little bit interesting when you hear the chairman message from yesterday. We are seeing stocks show just a little bit of sign of life here, but the bond market still selling off pretty significantly. As you say, Fed Chairman Jay Powell is reiterating the testimony on day 2 on Capitol Hill, saying another 2 rate hikes will be appropriate this year to fight inflation.
We've come very far, and the reason why we maintained our rate at the last meeting was to give ourselves more time to stretch out the time for making these decisions. We moved very quickly at the beginning, and we gradually slowed down. This is just a continuation of that. But we are committed to getting inflation under control, and strong majority of the committee feels that we're close, but there's a little further to go with rate hikes.
And the latest jobs data out this morning didn't give much reason to doubt Powell's assessment of where things stand with monetary policy. Weekly initial jobless claims came in unchanged from the week prior. As for the markets, we checked for you all day long here on Bloomberg. The S&P 500 is up about 0.1%, 7 points. 43.72 is the S&P level. The Dow's up 10 points now. That's a little change to the upside, of course, 33.959 for the Dow. The NASDAQ is higher by 0.5% or 67 points, 13,570 for the tech-heavy NASDAQ. The 10-year Treasury is now down 15 30-seconds, yield 3.77%. The 2-year yield is 4.76%. NYMEX crude's trading lower, down 2.8% or $2.04, $70.51 for a barrel of West Texas Intermediate. COMEX gold is down about 1%, down $18.60 at $19.2630 an ounce. The euro trades at 1.0969 against the dollar. British pound 1.2738 after the surprise half percentage point hike from the Bank of England this morning. The yen is at 142.72. By the way, we're watching shares of iRobot this morning. They are down 9%. Reuters is reporting that European regulators are going to launch a full-scale investigation of Amazon's $1.7 billion acquisition of the Roomba maker. Once the initial probe is finished, Amazon shares are up 3.3%. That's a Bloomberg Business Flash. Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Brokers studio. We're just hearing some questioning of Fed Chairman Jay Powell in front of the Senate. Again, he testified yesterday in front of the House, continuing the consistent messaging, Jess, that fighting inflation requires higher rates.
And he was a little bit more specific this time around, talking about how it would be appropriate to raise rates twice more this year. So when we thought we wouldn't get additional information, we got a little bit more today.
We got a little bit more. Let's bring in Bloomberg's International Economics and Policy correspondent, Michael McKee. He joins us here in our Bloomberg Interactive Broker studio. So, Michael, as Jess was just mentioning, kind of talking about maybe even 2 rate hikes this year. Is that something new for the marketplace, or is that just a little bit more clarity?
Actually,
maybe
James Bullard had mentioned this about a month ago.
Well, the Fed put that into their dot plot.
Right.
So we came out of the last meeting with the Fed saying basically we're going to do 2 more. And yesterday, Powell was asked about it, and he said if the economy develops as we expect, then that's a pretty good guess. The question is going to be, how does the economy develop? Does it develop as they expect? Do we see a rapid decline in inflation, particularly core inflation, if we see rents start to finally go down, which everybody's been expecting for a long time, if used car prices drop off? Could we see a kind of inflation story that would keep the Fed from doing 2? Certainly possible. And there are certainly a lot of people out there who still think we're going to see a recession before the end of the year.
And especially when you're looking at what's happening with the bond market today, what do you think that's really telling us when you're looking at the divergence between the bond market and obviously the stock market?
Well, I think what you've got today is the Bank of England and other European banks having a major effect on what's going on as people are sort of taking advantage of interest rate differentials here and reacting certainly to what was a very small surprise. They call it a surprise in the UK. I think everybody was leaning that direction. So it's really not about the U.S. at the moment. For the last week, Powell's had a story, and he's stuck to it. We did get an additional comment today from Mickey Bowman, who's a member of the board, who's always been really focused on banking issues and not so much on monetary policy, but she came into the last meeting saying she thought rates needed to go up, and she reiterated that today, that they have more work to do. She didn't put a number on it, but she said, we still have to raise rates.
So that Bank of England move here, 50 basis points today, or half a point, they're up at 5%. What did you take away from that?
That they think they have an inflation problem.
Yep.
Clearly, their situation is different from others in that they've got Brexit on top of the other inflation problems that they've got. And so also it appears that I don't want to call it a wage price spiral, but a wage push.
Yep.
Inflation is maybe starting to take hold there, and they need to stop that if they want to bring inflation down. But the interesting thing is the Bank of England has an enormous impact on England,
right,
the rest of the United Kingdom, but it isn't going to really affect
right.
the U.S. We're a much more closed economy and domestic demand driven. So what's happening overseas isn't as much of an impact on us as what we do impacts them.
Right, and when you think about, obviously CPI isn't the Fed's preferred gauge, it's CPE, but looking at where CPI, when it peaked out a little bit above 9% last year to where it is now, but we will get another reading on PCE next Friday along with consumer spending. What are your expectations versus obviously when we got those quarterly projections from the Fed last week?
Well, we do expect PCE to go down a little, but not a huge amount in the same way that CPI has worked. PCE has a little bit lower level than.
Is it also the housing component differential when you're looking at
that's
CPI versus
that's going to be the
PCE?
question. It hasn't really hit either of the indexes yet. We've seen a little bit of a decline in the CPI. Now, housing is a smaller component in the PCE, but it would still make a big difference in going down. Healthcare, a big issue for the PCE, so we'll see how that plays out as well. I don't think the Fed is expecting a major change right away, but they would like to see some progress, incremental progress, continue to be made.
You know, we got another initial jobless claims number today, Michael, kind of right in line with kind of expectations, a little bit higher, but right in line with last month. No real big move one way or the other. What do you think the Fed would like to see in the labor market to kind of influence its decision making?
Well, like to see from an economic standpoint is different from a human standpoint. Right. And we've heard a lot of that in today's Senate hearing with Jay Powell, because Democrats have started off immediately by talking about the impact on the poor and minorities when you raise rates. Yep. They're the first ones to lose their jobs. But the Fed does need to see the labor market cool down enough to bring down wage pressures, to get us to the point where companies are not having to pay up to get more people to work. And so far there's been some progress on that, but we're still seeing wage gains at the same level as or outpacing wages, and so or inflation. So we're kind of watching at this point to see if that translates through into the economy. And so the Fed looks at jobless claims, the Fed looks at JOLTS, the Fed looks at job creation and the unemployment rate, and all those things together try to give them a picture of where the labor market is going.
Is there enough data between now and the Fed's meeting in late July to really sway them one way or the other, since we do have that employment cost index coming after that meeting, and obviously just one more CPI report on July 12th?
That's a question a lot of people are asking, and hopefully Jay Powell gets asked today. He wasn't asked about it specifically that yesterday, but there is only one jobs report and one PCE, one CPI report before the Fed's next meeting on July 26th. And so is there enough data to really sway them one way or another, or are they going in there with essentially their minds made up, and you would need to have a major move in one of the data points to get them to do something? And that was the question I asked him at the press conference that he dodged, and that so far he hasn't been able to, nobody's been able to draw him out on that.
All right, Michael, thank you so much for joining us. As always, Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us here in our Bloomberg Interactive Broker Studio. Let's pivot here to the big take story of the day on the Bloomberg Terminal. We love the big take stories. They are so well researched, so well reported.
Always the best.
Yeah, deep, good team efforts. They really dive deep here. And today's a good one. Talking about the electric vehicle market and Ford Motor Company in particular. They're racing, as is GM and Stellantis, to kind of really take the lead here in this EV transformation. Ford gets $9.2 billion from the U.S. government for this effort. Akshat Rathi, one of the reporters on the story, he's a senior climate reporter with Bloomberg News. He joins us here. Akshat, talk to us about Ford and the support it is receiving from the government authorities to kind of make this transformation to electric vehicles.
Right. Every car maker has to make this transformation, and it's not going to be cheap. It has to be made, but it's not going to be cheap. And that's where the U.S. government is coming in. Ford last year said it's going to spend as much as $50 billion over the next 4 years towards its electrification strategy. And this $9.2 billion loan, it's a conditional loan. The conditions are very light and they'll meet them, no doubt. But that will go towards building 3 battery factories. And that is a lot of battery factories, but still not enough. Ford has an ambition to electrify its entire fleet, but it's starting out with increasing its number of electric vehicles made from 130,000 last year to 2 million by 2026. So that's quite a jump, and they need all the help they can. And Joe Biden's climate plan is allowing the government to be able to give these billions out right now to be able to encourage these companies down the transition.
And what you were mentioning, Ford did have an investor event last month, actually, where they were focusing on this $50 billion plan for EV models and the availability and the cost of these crucial battery metals. And when you're thinking about nickel and cobalt, they've been key concerns for years among EV makers trying to build out their electric lineup. So what do you think are the main hurdles at play?
So the main hurdle from a Ford perspective actually is profitability. Ford is going to lose $3 billion this year on its EV business, and it says it's going to turn the losses into profit by 2026. Of course, that is just from a company's perspective, but you're right. Metals are going to be another constraint. And so this program, the U.S. government program, it's called the Loan Programs Office, which gave this $9.2 billion loan for a battery manufacturing facility, is also giving out billions of dollars in battery recycling facility. And so the goal would there be to take the batteries that are already in the United States, recycle their metals, and reuse them. So that's one way in which you can deal with the metal crunch that is coming. But another is that you're going to have to mine metals. And now, is America ready to do it domestically? That remains unclear. It's very much a live topic in the U.S. Congress.
So, Akshat, just give us a sense of this $9.2 billion, the 2 or 3 plants they're thinking about here. Where is that in total, the total need that they will have for these types of facilities? Is this just kind of a good first step, or is this kind of a giant leap for fulfilling their ultimate needs, I guess?
It's actually both, which is to say they're going from 0 battery facilities to 3. So it's a giant leap. But it's the first step, because if you're going to have to electrify your entire fleet, you're going to have to build many more battery factories. And that's probably why this loan makes sense. If it's a giant leap, companies are typically conservative in taking those and getting a bit of government support, which would be in terms of a loan with conditions that are easier than what you would get on Wall Street, can make the difference between making a decision or not. And so that's going to help Ford. But you're absolutely right. There is a long way to go for Ford to transition to a fully electric vehicle company, which there is already one giant one in America called Tesla.
I was just taking a look at Ford's stock. That's ticker symbol F. It's up about 22% this year. After that investor day last month, do you think they were successfully able to persuade investors on the merits of this plan when you are looking at this 16-fold increase in EV production in the span of just a few years?
Well, Ford is trying to convince the investors as hard as it can. So there was a long conversation, internal, I'm sure even longer, to try and see whether it is worth splitting the company into its EV business and into and its separate traditional engine business. But Ford came to a conclusion that that wouldn't be right, because there are certain specializations between the two companies on design, etc., on manufacturing also of some components that are just too good to give up. You would have to replicate, you would have to actually increase costs. And so they decided in the end to stick with one company doing two things. But they are going to separate out the business in reporting terms. And that's going to give investors an insight into whether this transition is going as Ford thinks it can go with this current business structure. And, you know, given that the stock price is up, clearly clearly investors are in a position thinking that Ford's going in the right direction, but it's going to be analyzing as things go. There are clearly plans, and Ford is starting to execute them. Now, how well it executes them is the question.
Akshat, how about the Ford's competitors in the U.S., Stellantis and GM? Is the U.S. government prepared to support those as well?
So the U.S. government has already funded a GM battery plant. So GM got $2.5 billion last year in December 2022. And Stellantis is actually getting money from the Canadian government.
Okay.
So in Canada, Volkswagen got $10 billion, and Stellantis is in conversation to get something similar for its battery factories. But yes, it's one of those industries where profitability is hard, upfront investments are high, and they tend to be national champions, so to speak. And governments want to protect them both for having the company domestically, but also from the perspective of jobs that they give to many, many different states that they operate in.
All right, Akshat, great reporting for you and your team. Appreciate that. Akshat Rathi, senior reporter for climate for Bloomberg News. He and his team put out this Big Take story. Always good stories. You can find those stories at bloomberg.com/bigtake or NI space Big Take Go on the Bloomberg terminal. Again, we love to highlight those stories because they're usually really interesting topics, timely topics, and they are deeply reported and well written. So love to bring those to the airwaves. We're gonna have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Deutsche Bank's boss sees a recovery for fixed income trading on the horizon. After warning last week of a 15 to 20% drop in trading for the current quarter, CEO Christian Saving now tells Bloomberg News.
We can already see also now in June, on the most recent days, that there is momentum in the business. So I'm overall actually quite comfortable also with the FIG business. And again, Q2 was a particular quarter. I would say that the FIG business in Q3 and Q4, I think there was a slight recovery.
Saving has pledged to increase revenue and profitability following a turnaround that included thousands of job cuts and an exit from equities trading. Shares of Uber are up following word of more job cuts. Bloomberg's Jeff Bellinger reports.
Steve, the ride-hailing service is cutting 200 recruiters to save money due to tighter economic conditions. Dow Jones says the latest layoffs, combined with previous cuts this year, account for less than 3% of Uber's employees. A memo from Chief People Officer Nikki Krishnamurthy said that with attrition being low, the size of the talent acquisition team needs to be right-sized. She added that widespread layoffs are not in store for Uber. That was not the case for the company's main rival. Lyft eliminated more than 30% of its workforce after losing ground to Uber during the pandemic. Steve?
Thanks, Jeff. And Warren Buffett takes stock in the importance of generosity. Buffett donated roughly $4.6 billion in Berkshire Hathaway shares to 5 charities, and that includes the Bill and Melinda Gates Foundation. The 92-year-old has said his estate will go, 99% of it will go towards charity. I'm Steve Rappaport, and this is...
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Metton and Paul Sweeney here in the Bloomberg Interactive Brokers studio, looking at the markets here. A little bit of a mixed tape out there. The S&P off about 1/10 of 1%. NASDAQ actually up just a couple of ticks here, so not a lot of direction there. We are looking at yields. They are moving higher. The 10-year Treasury up 6 basis points, 3.77%. The 2-year up about 5 basis points. It's called 4.76%, so a little bit of move in the yield space. Bitcoin, it's down actually a little bit, down almost 1%, below $30,000 per token, which it had held for a couple of days here. Right now, let's head down to Washington, D.C. We're going to get world and national news, and we will do that with Amy Morris.
Thank you, Paul. Deadly storms and extreme heat hitting parts of Texas this week. It is so hot in Texas, the Postal Service says a letter carrier in Dallas died while delivering the mail in the heat, where temperatures felt like 116 degrees. Texas Department of Transportation spokesman Danny Perez says they are also closely monitoring worker safety on the road.
Making sure they're staying hydrated, making sure that they're aware of their situation, making sure that they're not staying out longer than they need to.
Perez says crews are working to repair roads south of Houston. Those roads were buckling in the heat. Several cities have shattered all-time heat records. It felt like 127 degrees near Corpus Christi. The federal government's case against Donald Trump is moving forward in Florida. Prosecutors turning evidence over to Trump's legal team. Evidence is being handed over to the defense. Both sides getting ready for that August 14th trial date, including grand jury testimony of witnesses set to testify at the trial. A 2021 recording of the former president talking about having some classified information in his possession and other public statements he made, plus an FBI interview of his personal aide, plus pictures of boxes of records at Mar-a-Lago. Both sides are barred from publicly sharing evidence that's been turned over. Trump's attorneys are working on getting security clearances now so they can review any of the classified material. Last year, there were more pedestrian deaths in the U.S. than we've seen in decades. The report by the Governor's Highway Safety Association finds that last year, more than 7,500 people were killed while they were walking, more than 20 people every day. CEO Jonathan Adkins says the sad part is those types of crashes are preventable with better designed infrastructure, lower speeds, and addressing risky driving behaviors. The rising number of deaths on roads comes as the National Highway Traffic Safety Administration continues lacking permanent leadership. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
Thank you, Amy. Jess Minton, Paul Sweeney here in the Interactive Brokers studio, and I can account for this excessive heat warning in Corpus Christi since I did grow up there. I can attest to just how hot it is down there.
Amy was reporting it was like 120. What are you people doing down there?
I mean, I actually anecdotally had some friends that were at the beach over the weekend that once it was around noon, they ended up packing up and going home because it was too hot for them, even going in the water.
Is that, I mean, I guess that's just kind of normal for this time of year?
It is. I feel like summer actually really starts around when spring break is in March. So it's really kind of summer year-round there. There was this one Christmas where it snowed, which was a complete one-off, but...
So, all right. So how warm does the Gulf get? Like, if it's 100 and some odd degrees out there, can you just go in the water and cool down, or is the water, like,
the water's pretty warm, too. So It kind of doesn't always help the salt water. It kind of makes it worse there, but...
Holy cow.
But hey, I mean, it's still a good time.
It's still a good time. I mean, that's like a spring break mecca, right?
It is.
So if
the South Padre is the mecca.
South Padre Island, is that down there?
Yes.
I mean, so if you go to UT or Texas A&M.
Texas A&M, yes. And that other school in Texas, you go down to South Padre.
So that's kind of like the Fort, like my day, it was Fort Lauderdale, Florida, like South Florida was kind of where the eastern schools.
Right. No, we didn't go there. We went to South Padre.
Wow. I bet you got some stories from down there.
We do.
We do. What happens
We're
in
not
South
going to talk
Padre
about it
stays
here,
in
though.
South Padre? All right, just looking at the markets here. Let's get back to business here. Again, you got off about 1/10 of 1% on the S&P 500.
Right, that would be on track for its fourth consecutive day of losses, which would be longest streak since early May.
Oh, okay, good stuff. All right, but still feels like, the S&P's up 13% year to date, up about 23% off that October low. So what can you say? And even the SPW, the equal weight, is up about 3 or 4% year to date. All right, we're going to have more Bloomberg Markets starting right now.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this half hour, we're going to check in with Dana Peterson, chief economist at the Conference Board. We had some additional economic data coming from the Conference Board, leading economic indicators still showing some very, very cautious signals. We'll check in with Mike McGlone. He's a senior macro strategist with Bloomberg Intelligence. Talk a little Bitcoin. It's pulling back today, but it was over $30,000 per token to start the day. We're going to talk to him about some metals and aluminum as well, because he covers all the commodities. And then in our C-suite conversation, Keith Taylor, CFO at Equinix, joined the show to talk about digital infrastructure and, you guessed it, AI. That's all coming up. But first, let's go to Nathan Hager and get a Bloomberg Business Flash.
Yeah, the stock market might be showing a little bit of sign of caution here, Paul. Stocks are sort of looking for direction right now, with Fed Chairman Jay Powell back on Capitol Hill, reiterating his message to lawmakers that the pause last week doesn't mean the Fed's done. There could be 2 more rate hikes before they get inflation in line. Yelena Shulyacheva, senior U.S. economist at BNP Paribas, says the message she's heard this week from the chairman is one of balance.
He sounded a bit more balanced in terms of the economy and the future path of monetary policy. He said, well, yeah, consumer spending is still strong, but businesses are feeling the impact of higher interest rates, and the labor market is coming back into balance. Again, this word balance, I think, is really important.
And we have seen signs of softness in the labor market. Initial jobless claims came in unchanged from the week prior. Chairman Powell is saying he doesn't think the softness in the labor market will mean major job losses. We checked the markets for you all day long here at Bloomberg, and right now the S&P is down 2 points. That's little changed. 43.63 is the S&P level. The Dow is down 62, or 0.2% at 33,889. And the NASDAQ is still holding on to a gain. It's up 38 points, or about 0.3% at 13,540. Seeing some selling in the Treasury market right now. The 10-year is down 18.30 seconds, yield 3.78%. The 2-year yield 4.77. NYMEX crude is lower by 3%, down $2.18 at $70.35 a barrel. COMEX gold is down almost 1%, down $18.40 at $19.2650 an ounce. The euro 1.0957 against the dollar, the yen 142.81. Bitcoin is a little bit lower, down 0.6%, just below the 30,000 handle at 29,800. Overstock shares are higher by 11.3%. It is the winning bidder for some of Bed Bath & Beyond's assets. Now that it's gone into bankruptcy, it's going to pay $21.5 million for some of Bed Bath's IP. Boeing is down almost 3%, while its biggest supplier, Spirit Aerosystems, is down nearly 11%. Spirit Aero's union workers voted to strike. That's a surprise move, and it could disrupt Boeing's plans to ramp up production of its cash cow, the 737 MAX. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much for that. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Brokers Studios. Nathan's just reporting not a lot of movement out there for the major indexes. I'm looking at the WEI function that gives you the world equity indices, and it's showing their volume, kind of 7, 8, 9, 10%. Kind of below the 30-day trend, so not a lot of volume out there either.
Take a look at the SOX. It's actually flat today at the Philadelphia Semiconductor Index, but obviously up more than 40% this year. But who better to bring in to talk about chip stocks with us than Katie Greifeld, star reporter, cross-asset team. Katie, what are you looking at when it comes to names like NVIDIA this morning?
NVIDIA, there was such a great story out on the Bloomberg terminal about NVIDIA now tops Tesla as ESG funds ratchet up exposure to AI. I love how many acronyms we have.
Yes.
Okay, now we're talking about AI is now ESG, et cetera. Let's put that in an ETF. But in any case,
And all I know is that it comes to your show. Everything comes to your ETF show.
It all comes up, Katie. At
Yes.
the end.
I love it.
That's the red headline here.
This is a great story by some of our colleagues at Bloomberg News. They crunched the numbers. There's now over 1,400 ESG funds that directly hold NVIDIA. That is according to latest filings. A further 500 are indirectly exposed. That actually surpasses typical names that you think of, such as Tesla. And this gets into an interesting wrinkle to ESG, which I always harp on, is that a lot of these funds are just tech funds. They tend to be loaded up on these tech names. As a result, I mean, some of the big ESG funds are outperforming this year.
Are they? Yeah, see, that's kind of my take. And I do my best to learn and read everything I can about ESG. But when I look at any ESG fund, I feel like I'm looking at.
I know.
It could be the Fidelity Contra Fund. I mean, it's tech. It's some health. I don't know.
It's such a broad umbrella.
Yes, it
I
is.
mean, you think about the three distinct buckets, and I mean, Tesla is sort of at the epicenter of this because it's good for the environment, theoretically, getting away from gasoline.
Right.
But then you think about some of the governance issues. Should that be in an ESG fund? That is the age-old question. But to performance, I mean, again, a great story on the terminal. Some of the ESG registered funds with the biggest return so far this year include one managed by T. Rowe Price. It's up about 45%. That's because NVIDIA is its fourth largest holding. Its top three stocks, though, are Apple, Taiwan Semiconductor Manufacturing, and Microsoft.
Looks like my portfolio.
Yeah.
Big whoop. All right, so I want to talk to you about, we had some news over the last couple of days in the crypto space and ETFs. Can you tell us what's happening there and how it's different maybe? So just explain to our listeners kind of what's going on.
My heart rate just shot up.
I know.
I'm so excited to talk to you about this. Okay, we're talking about BlackRock here.
Yep.
Last week, BlackRock filed for a physically backed Bitcoin ETF. This is a structure that doesn't exist. The SEC, at least in the US, the SEC has repeatedly denied applications to this effect. So to see BlackRock filing for it, it's fanned a lot of speculation, a lot of rumor. I've quoted a lot of analysts to the effect of BlackRock may know something here. Maybe they got some sort of heads up from regulators, because I haven't crunched this data, but it'd be interesting to see how many times BlackRock has filed for an ETF and gotten rejected. We're talking about the world's largest asset manager, the largest ETF issuer. To see them file for this sort of ETF that doesn't exist definitely has sort of refueled a lot of optimism around the crypto space. And we've seen a lot of issuers sort of follow in their wake, filing their own applications for spot Bitcoin ETFs.
That's interesting. So the likelihood of it potentially going through more likely?
So Eric Balchunas, unfortunately, is off this week. He's been tweeting up a storm, though.
Is he down the Jersey Shore?
Somewhere, or Florida. He goes to Florida a lot. We'll have to check in with him.
He's getting to that age. So.
Yeah. But he tweeted, he puts the odds of this going, of spot Bitcoin ETF approval at 50% now that we've seen BlackRock file for this.
And why did the regulators to date said, no, this just seems like a natural. I mean, crypto, super hot, ETF, super hot.
Bring it together.
Yeah, I could bring that together.
We have ETFs for everything else in the U.S., and you're striking onto a very hot topic in both the crypto and the ETF worlds, because we have Bitcoin futures ETFs in the U.S. So a lot of people have argued the fact that you have approved the futures version and you're denying the physically backed version, that the logic doesn't hold there. So, I mean, the SEC stance is that they seem to really harp on the fact that they don't have oversight to the exchanges. They've cited fraud and market manipulation concerns in denying these applications in the past. And actually, Grayscale has sued the SEC. They're engaged in a lawsuit right now over the fact that the SEC denied their request to convert their Bitcoin trust into an ETF. So this is, I mean, it's a really thorny debate. It's been going on for years. And the fact that BlackRock filed for a physically backed structure sort of pushes us to a head. So it's going to be fascinating
Any
to
sense
follow.
of timing here when we might get something? Like, how does this usually play out? Because I mean, again, BlackRock, you don't, I mean, that's big. It doesn't get any bigger than that.
Yeah. I mean, usually for ETF filings, it's 75 to 90 days. You expect to see some sort of movement. The SEC can push out their decisions on approval, so we'll see if that happens in this case. But again, it does sort of put a deadline here. We will get a decision, so it's very exciting. And Bitcoin, I mean, it's just been absolutely on a tear. I haven't crunched the numbers today, but as of yesterday, Bitcoin was up like 18% in the days since BlackRock filed for this.
We have Mike McGlone from Bloomberg Intelligence coming up in the next half hour to talk more about Bitcoin.
He must be psyched.
Oh, I'm sure he is.
Miami Mike.
Miami Mike.
There we go. That's good. I like that. That's going to stick. He went down there when everybody else decamped from the New York area. He saw his little opening. He jumped on it.
Yeah, that's what I'm calling him going forward. Miami Mike.
Exactly. All right, Katie, thank you so much for joining us. Katie Greifeld, she's cross-asset reporter, does all things ETF as well, so we appreciate getting a few minutes of her time. Let's talk a little eco data here.
Switch it up.
Yeah, we had the leading economic indicator came out today from the Conference Board. I'm kind of pulling it right up here.
Continuing this streak where it's been negative for over 12 months now.
Yeah,
and that's something very rare. We haven't actually seen instances where that's happened over the past 50 years. Just a few, like in the 70s, early 80s, in 2008. So obviously each time the U.S. economy was already in a recession. So the question is, how do you square that away, right, with the strong, resilient data we've seen with the consumer recently?
Yeah, so let's bring in Dana Peterson. She's the chief economist at the Conference Board. Dana, thanks so much for joining us here. Talk to us about the leading economic index, what you guys reported today, what it tells you, and what should we take away from all this?
Absolutely. So the leading economic indicator fell again for, I think, the 14th consecutive month. And the weakness was definitely in expectations from the ISM in terms of manufacturing and also from consumers. And then the yield curve continued to be negative. And also the leading credit indicator was negative. So that's all telling us that there's still some weakness out there. There's still expectation that maybe we'll go into a recession. Certainly it's pointing to recession starting probably about now. I know we keep forecasting it, but the key thing is that there's been strength in the labor market that's definitely forestalling what we think is the inevitable.
It's interesting because even though it's a leading economic index, a lot of investors look at it more as lagging just because of when you're looking at the economy. And since investors are looking, 6 months, 12 months out, do you think that's why we're seeing the stock market more supported? Do you think investors think the worst of the pain is already past?
Well, I think investors are looking at data like labor markets, and indeed in the leading economic indicator, and even in our current economic indicator, the labor market data are holding up. Why? It's because of labor shortages. And so many businesses, instead of letting people go, they're holding on to their workers. And then you also still have a number of sectors that are still trying to catch up from losses during the pandemic, especially services that are in high demand. And so if you're looking at that, I understand why investors might look at our measure and say, well, what's going on here?
Right.
So talk to us about the housing market data. That continues to kind of befuddle me in the midst of rising interest rates, still strong. How do you think about the housing market right here?
Well, I think you're coming off of very low levels. When you look at most of the housing market data, it really slowed dramatically last year. And it seems like we kind of reached a bottom. So you're in a hole and you're just trying to climb out of that hole. And so the thing is that we're probably not going to see a real resurgence in housing activity until next year when we think the Fed will begin cutting interest rates.
So if you're expecting more of that weakness in the economy to start around now, where is it being driven by? Is it the consumer, which obviously, propelling GDP by more than 2/3 of when we're looking at economic growth?
Well, it's got to come from several places. Already, like I said, the housing market has collapsed, and we think it's just going to be middling. So it's not going to be a contributor. But businesses have been pulling back, certainly on spending on equipment and also structures, because the cost of capital is rising for many of them. And you definitely need consumers to spend less. So we have seen a little bit of moderation in terms of spending on big ticket items that you have to finance. But consumers are still spending a lot of money on services, especially travel and restaurants, things they couldn't really spend on during the pandemic. So the key thing is when that excess income that consumers have, the excess savings go away. We think they're going to run out of steam in the second half of this year. And also we think consumers are going to become a little bit more concerned about job prospects, and that might cause them to pull back on some of the spending as well.
A follow-up I have to that is when it comes to the repayment for the student debt that was delayed, obviously, and going through forbearance during the pandemic, that's supposed to resume in October. So when you're thinking about the consumer and those types of payments that are going to start up again, is that also going into those calculations of a pullback there?
Absolutely. We have folded that into our forecast for the second half of this year. And then also, let's not forget the debt ceiling deal. While that's not really going to affect the fiscal year 2023, it does affect fiscal year 2024, and that starts in October as well.
Dana, talk to us about your view of the labor market here. Still, very strong by historical measures here. And I know the Fed is talking about they expect the unemployment rate to go up and, maybe have a 4 handle here in the not too distant future. What's your view at the Conference Board?
Yes, we think also that we're probably going to have a 4 handle, that the unemployment rate may ultimately rise by 1 percentage point to 4.5%. But that's not going to happen probably until early next year because the unemployment rate really lags what goes on with GDP. And so certainly if the Fed continues to hike interest rates, which is strongly signaling, Chair Powell signaled that certainly to Congress very recently, then that's also going to weigh on the economy and consequently the labor market.
What industries do you think are most vulnerable to layoffs right now?
So those pandemic darlings, those industries now are very vulnerable. So tech, finance, residential construction, and real estate.
So some of the sectors that we've continued to see those cost-cutting efforts, those are going to still be the ones that we'll see.
Absolutely, because there's not as much demand for their products and services.
All right, Dana, thank you so much for joining us. Always appreciate getting some thoughts from you. Dana Peterson, Chief Economist at the Conference Board. The leading economic indicator data out today, kind of showing some continued weakness. And I think that Dana said 14 months in a row with a negative number, so it's very interesting to keep an eye on that. Again, it came in at negative 0.7% on the leading index versus negative 0.6% last month.
Right, and it's something that's very rare to see. And so we were actually crunching the numbers on my team recently about this. So if you look back the last half century, the U.S. equities team. So the past 50 years, there were just 3 instances where you saw a streak like that happen. So 1974, 1980, 2008. In each time, the U.S. economy was already in a recession. But Bloomberg Intelligence, you look at their regression model for Gina Martin Adams, that was telling most of the pain was already looking like it was priced into the economy actually last year. So a little bit of ruffling feathers there when people want to have the debate about where the economy's headed.
Yeah, I love that research by Gina Martin Adams and her team at Bloomberg Intelligence. They're saying, hey, the market's already priced this thing in, kids. I mean, it was last October when the markets hit their lows. And that's been a pretty bullish call, and she's been right. Boy, I tell you what, the market's up, S&P up well north of 20% off of that low, NASDAQ up over more than 30% off of that low. So we'll see where we go from here. We're going to have more coming up. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, don't expect Tesla to lose its lion's share of the electric vehicle market anytime soon. One analysis predicts Tesla will remain the top EV seller in the U.S. through 2026. Bloomberg's Charlie Pellet reports.
The report comes from BofA securities analyst John Murphy in his annual Car Wars report. He says Tesla is benefiting from renewed sales momentum sparked by a recent discounting binge. Murphy says the automaker's models should account for 18% of the domestic EV market in 2026. That will leave GM and Ford to fight for second place with about 14% each, followed by Stellantis at 8%.
Thanks, Charlie. It's slim pickings for would-be home buyers. More from Bloomberg's Gina Cervetti.
Real estate brokerage Redfin says active listings in May fell by around 7% to the lowest level since 2012, which is as far back as Redfin goes with the data. And from pre-pandemic levels, listings have plummeted by nearly 39%. High mortgage rates are keeping many people from putting their homes up for sale.
Thanks, Gina. Paul and Jess, what's more American than apple pie?
4th of July. I don't know.
Well, how about apple pie with cheese on it?
No,
that's
no,
different.
not good.
Yeah, Kraft Singles is dabbling in dessert for the 4th of July. The company is partnering with Little Pies Company to whip up Kraft Singles apple pies topped with a slice. They're available at the Little Pie Company store in New York for $10.95 or online through Goldbelly for about $45 plus the cost of shipping. So enjoy that on your 4th of July. Let me know how it is. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Nathan Hager, watching Treasury yields climb as Jay Powell reinforces his message to Congress that the Federal Reserve isn't done yet with interest rate hikes, as inflation is still too high for the Fed's liking. We check the markets all day long here on Bloomberg, and the 10-year Treasury is now down 18/32, bringing the yield up to 3.78%, and the 2-year is at 4.77. The S&P is little change to the downside. The Dow is down 52 points, and the NASDAQ is higher by 49 points. 4 of the 11 main industry groups are in the green for the S&P. The highest, consumer discretionary, real estate, and energy are dragging the S&P lower for the most part. In fact, West Texas Intermediate crude right now is down 3.7%. trading at $69.79 a barrel. The Energy Information Administration reported this morning that Cushing crude prices fell for the first time in 9 weeks, supplies, I should say, and oil demand jumped to its highest level since December. COMEX gold right now is down 1%, or $19.60 at $19.2520 an ounce. The euro is at 1.0959 against the dollar. The yen is at 142.83. Bitcoin is lower by 0.7%, just below 30,000 at around 29,800. J.P. Morgan Chase will pay a $4 million fine to settle claims from the Securities and Exchange Commission that the Wall Street Bank mistakenly deleted 47 million electronic records in 2018, leaving communications unavailable to regulators who are conducting investigations. J.P. Morgan shares are down 1.6%. That's a Bloomberg Business Flash. And Bloomberg Markets continues now with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're going to go to Mike McGlone. He's a senior macro strategist for Bloomberg Intelligence. Jess, should we tell Mike what we just nicknamed him?
Miami Mike.
Miami Mike. That's what we're going with, Mike. That's you can thank Katie Greifeld for that, but you are forever known up here in the Bloomberg radio circles as Miami Mike. How do you like that?
I'll take it. I actually last night got to shake Mayor Suarez's hand for the 4th time last night, so I feel like I'm entrenched in the city.
You are our guy down there, and that's great. Hey, Mike, you know what we've been hearing about a lot over the last few days is that this equity market is overbought. A, do you buy that? And B, if so, what do you look at to kind of give you that sense?
Well, I really appreciated your conversation about Gina Martin Adams earlier. She has been spot on, but right now we have a little dichotomy, which we're supposed to with pure research professionals with Anna Wong. Anna Wong is our chief economist. Now, she points out the term she's used for second half is ugly for the U.S. economic trajectory. Now, she started saying this a year ago, and she said it would start in basically 3Q. She moved a little forward with the banking crisis. So I'm going with that, and I look at it as first you look at it as a simple risk asset manager or a trader. Markets have bounced in this hopium for a soft landing and the Fed eventually eased. So the risk is it all tilts back towards a recession, the Fed not easing, and what you're seeing testifying right now from Chairman Powell, he is banging hard. He has no incentive at all to let the markets know they're going to provide more liquidity. So the lessons of liquidity and contraction, money supply minus 5%. You mentioned LEI. The annual measure is down, has dropped the most in about 30 years. It's down almost 8%. To me, that all tilts towards a pretty ugly second half. And I think that's the risk. Also, there was one little thing metric I'll end with. Just last Friday and Tuesday, the NASDAQ reached about 24% above its 200-day moving average. It has not sustained above that level, that high, lofty level, since the internet bubble that ended in 2000.
Now, when it comes to what's happening with the Bitcoin space, because I know you cover all things with this, it actually hit its highest level since April yesterday after, obviously, when you're thinking the correlation with this ETF type optimism that Katie Greifeld was just here talking to us about that. What are you seeing there with Bitcoin? And because the last time you were here, we were talking about how that 30,000 sort of threshold level was still this psychologically key level that investors were watching.
Exactly. I stick with that, Jess. I just sent an editorial. I'm going to point that out for publishing tomorrow, that there's so much enthusiasm about this 30,000 level. I think the risk is similar to the stock market. If we get a little bit of rollover, the fastest horse in the race that went up the most, this year again, it bounced, risks going back down. Now, this ETF from BlackRock, Eric Balchunas points out it might not get approved until next year. We don't know that for sure, but there's so much enthusiasm here at this level here. I look at it as the macro is still unfavorable. Bitcoin faces its first recession. It's one of the riskiest assets in the business. It's still the least risky crypto, and it's at this key threshold. And my sense is from digging into all the crypto people is they're all a little too giddy. I sense this around 60,000 when Mayor Suarez took his salary in Bitcoin. So I'm concerned at these levels that we're going to have. Here's the bottom line. I'm concerned we're going to have that ebbing tide in the stock market. Hopefully, Gina will be right, but I'm sensing more, at least get a correction, and then Bitcoin will drop with that. So what we need eventually is Bitcoin to either outperform the NASDAQ, but the problem is it's been the same level of the NASDAQ since 2017. It's about 2-to-1 right now versus the NASDAQ. And or we needed to transition in a recession towards trading more like treasury bonds or gold, and it's just not there yet. Maybe it's starting, but I don't see it yet.
Mike, if we're having a tough second half economically, what in the commodities space are you looking at? Is this my time to go out and buy pork bellies? What should I be thinking about?
Yeah, gold. The only thing I think, gold's backed up. It's rallied, but it's still up 5% in the year. I think gold's going to be the best performing commodity, probably one of the best performing commodities as we tilt to this recession, specifically get to a serious recession. But the problem I see for most commodities, it's still a bear market, and typically to bottom a bear market, you need a long lag to a significant amount of Federal Reserve easing, and we're still tightening. And that to me is a key thing. So just today, right now, crude oil is down another 4%, it's at $69 a barrel. I'm still looking forward to head towards $50 a barrel, and there's precedent for that. It's done it since 2014. It's actually since the financial crisis in 2000. And this year already, natural gas has done the equivalent. So I look at commodities, they're still bear market. And the bottom line is you have to ask yourself, what ends that? All the data from China is disappointing, and the Fed and most central banks are still tightening. We just saw the Bank of England just did a surprise 50 basis point hike. That's not a good environment for commodities.
Mike, when it comes to the gold to copper ratio, last time you were here, it was moving lower. Now it's actually moving higher this month. What do you think this is telling us in relation to especially when it comes to copper and what that means for the trajectory of the global economy?
Yes, so the gold outpricing copper is what I fully expect, and that's normally what happens in a recession, and when the Fed starts, it has to ease for that. So I think that's going to really break out and potentially make new highs. That's what it did during we had that big pump in liquidity right there, 2021. And this is things like the bond manager Jeff Gundlach watches. So gold to copper, I think, is going to break out higher. And also remember, the enduring propensity over time is for gold to beat most commodities. But certainly when it comes from having to hold that asset, it's the easiest and cheapest to store. And so I'm quite bullish gold versus most commodities, particularly crude oil, particularly copper. Copper and crude oil, the most industrial sensitive. And if Arno Wong's right, and the leading indicators are right, and the yield curve's right, the inverted yield curve, which I think it will be, then we should expect copper to underperform gold and gold to outperform in the next year or so.
It's interesting because that indicator actually rose with U.S. stocks after the lows in 2009, 2011, 2018, and in 2020. So does that actually point to brighter times ahead?
Well, it will point to brighter times ahead when copper starts outperforming gold. So this case right now, it points to recession. It fits in with Anna's model. It fits in with the inverted yield curve. And with plunging commodities. So I fully expect that we need some kind of shock. We need to not have this recession and the Fed a year from now to say, oh, we're still at the same rates because the economy is doing great. That will repress gold. Remember, gold is the competition for gold is high rates. You're getting 5% in a T-bill. That's great. And the stock market outperforming the rest of the world, the U.S. stock market. If that starts tilting lower, gold's going to beat most assets. So I see it right now is look at copper on the year. It's basically up about 2%. But here's a key thing, the way to look at copper. The dollar price of copper, if you overlay that with the S&P 500, just take the S&P 500 and divide it by 1,000, they've been almost the exact same for about 5 years. So right now, the dollar price of copper implies that the S&P 500 should be about 3,900, and it's currently about 4,400. The question, we'll see within the next few months if that has that relationship broken down, or is copper being a leading indicator and showing us what leading indicators are telling us that we're heading towards a pretty bad recession, which means the stock market's going to have a problem.
All right, I got your gold call. You've been very consistent on that, Mike. How about the poor man's gold, silver?
Silver has been a really good performer this year. The problem with silver is it's no longer a monetary asset. It's much more an industrial metal. It's been replaced by gold. Sir Isaac Newton started that in the 17th century when he was head of the U.S. The British mint. So I think what we've seen this year so far is a bounce in silver, just like we've seen in some of the other commodities. Like it's the stock market, but I think silver is going to more succumb to the recession. The industrial metals like copper trade lower, and gold will outperform. But overall, the price of gold versus copper is really versus silver, the gold-silver ratio has appreciated over time. I expect that to kick in and to rally, gold to outperform silver, particularly if we head to a New Year's recession.
All right, Mike, thanks as always for joining us. Always appreciate getting your input there.
Miami
McGlone.
Mike.
Yep, a.k.a. Miami Mike, senior macro strategist for Bloomberg Intelligence. We can talk to him about anything on the commodity space, including all that cool crypto stuff. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. After hours of debate that lasted early into this morning, a House panel has approved the annual defense authorization bill. Now, that debate focused on Republican social priorities, including efforts to eliminate critical race theory and curb diversity and equity programs. Democrats pushed back, but in the end, the House Armed Services Committee approved the measure, and the full House will be taking it up early next month to authorize $886 billion for national security programs, $11.8 billion of which will be for defense-related activities other than national defense programs. The Senate is also considering this bill, and once they do, they'll have to get together and make a compromise. A remote search vessel has reached the seafloor near the wreck of the Titanic as it looks for that missing submersible. Crews are also zeroing in on unidentified Noises they detected underwater as air runs out for the craft's 5-man crew. Those noises have been picked up in the past 2 days by Canadian aircraft with sonar devices. National Geographic editor Kristen Romey tells ABC that there's still much we don't know.
There's a lot of variables here too about, how much air was exactly available when the sub went down, and also what the crew is, if they are still present with us, what they are doing to conserve that air.
And another problem experts say is the below freezing temperatures in that area are increasing the risk of hypothermia. The U.S. population is older than it's ever been. New data from the Census Bureau show the country's median age now nearly 39 years old. Used to be 30 back in 1980. It's a pretty rapid rise. The New York Times reports we're still younger than European countries, where the median age is 44. The report shows that U.S. is getting older, posing challenges for the workforce, the economy, and social programs. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Nathan Hager. And you know how we talk about the 2 to 10 year Treasury yield curve as a potential recession indicator when it's inverted? Well, this red headline just crossed the Bloomberg terminal from Germany. The 2 to 10 year yield curve in Germany has inverted the most since 1992. Adding to some of the somber mood we're seeing in markets with hawkish central banks screaming loudly around the world. We saw the surprise 50 basis point rate hike this morning from the Bank of England, and Federal Reserve Chairman Jerome Powell reiterating his somewhat hawkish message after the pause last week, telling lawmakers in the Senate Banking Committee another 1, maybe 2 interest rate hikes may be needed to get inflation in the U.S. under control. Megan Robson, the head of U.S. credit strategy at BNP Paribas, doesn't think the Fed's going to go quite as far as 2 more hikes.
We do expect inflation to be sticky, so we're calling for 1 more rate hike in July and for the Fed to remain on hold for the rest of the year. For credit markets, I think what's very interesting as they've been very resilient despite this more hawkish message. We've seen credit actually hold in very well over the last week. We think what's going to drive markets for the second half is going to be the data.
And the data this morning came in unchanged as far as initial weekly jobless claims go, unchanged from the week prior. We checked the markets for you all day long here at Bloomberg. Right now, the S&P 500 is up by 6 points, or 0.2%. 4372 is the S&P level. The Dow is little changed to lower, down 18 points at 33,932. The Nasdaq's holding on to a gain. It's up 0.6%, or 86 points, 13,588. 5 of the 11 main industry groups in the S&P 500 are in the green, led by consumer discretionary and information technology. Real estate is the biggest drag right now in the S&P. The 10-year Treasury is down 16/30 seconds. The yield up to 3.78%, and the 2-year is at 4.76%. With the hawkishness in the market, we're seeing a sell-off in commodities. NYMEX crude is down 4.1%. It's down $2.99 now, $69.52 a barrel. COMEX gold is down about 1%, down $20.50 at $19.2460 an ounce. The euro, 1.0962 against the dollar. The yen, 142.81. Bitcoin is below 30,000, just shy of 29,800. That's a decline of 2/3%. Darden Restaurants is down 1.4%. They had a mixed third quarter, a beat for Longhorn Steakhouse, slight miss at Olive Garden, and an unexpected decline in fine dining. Darden says customers are watching alcohol spending at high-end spots like Eddie V's, Prime Seafood, and Capitol Grill. How's that for an economic indicator? Yeah. That's the Bloomberg Business Flash. Bloomberg Markets continues. Paul Sweeney and Jess Menton.
All right, Nathan, thank you so much. We appreciate that. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Here's a company, Jess, Equinix. It's like a giant-sized company, and I don't know anything about it. How do I?
Data center provider.
Yeah, I mean, that is, call it the backbone of technology. You got to put these data centers somewhere. I mean, it's a 70 billion market cap company, Equinix. EQIX is a ticker. The good news is we have the CFO in our Bloomberg Interactive Broker Studio, Keith Taylor, CFO of Equinix. Again, EQIX. We also have Jeff Langbaum. He is the REIT analyst who covers all of the REITs, including Equinix, because Equinix is a REIT. So we brought Jeff in here because he's the smartest guy we have in the building to talk about this company. So Keith, let's start with you. Talk to us about Equinix. What do you guys do? Number one. And number two, I know you guys had a big investor day yesterday. What was kind of the message you were trying to get across?
Yeah, Paul, look, Equinix, largest data center company in the world. Think of all things digital coming into our environment. We sit on a foundation of 2,000 networks, 3,000 cloud and IT services companies. We've got 250 data centers about around the world, and we're investing a tremendous amount of capital. All things digital belong inside Equinix.
What specific companies are you providing these connected digital infrastructures to? Because I've seen you also work with companies like Google Cloud, Zoom, Oracle. So these are some big names.
No, absolutely. But first and foremost, the top 10 customers for us represent about 18% of our business. And it's the large hyperscalers. And think of us as effectively on and off ramp to the internet and to the cloud. We have, again, 2,000 networks, 3,000 IT and cloud companies. We have majority of 40% of the cloud on-ramps. And so it's how data transfers through basically the systems. And for us, they need proximity, they need diversity, and we provide that. We're in 71 markets around the world. We'll soon be in 75, and 31 countries going to 35. So a very exciting time for us.
Well, and from the REIT perspective, it paints a very different picture than a lot of the other asset classes that we typically talk about, right? Demand is through the roof. I mean, they spent a lot of time yesterday talking about, the demand drivers for their business and just, just the connectivity. We haven't even touched on AI. I'm sure Keith is tired of talking about it, but I mean, that's probably the next wave, right? The demand for the data center business is through the roof, and you can see it extending out over the next whatever time frame you choose.
So what do you think about AI?
Well, I'd first say the opportunity is immense. If you believe that all things digital have a home inside Equinix, and you think about AI, where it will take us, I just think it's a broader opportunity for us. So it's exciting, whether it's autonomous driving, whether it's AI, whether it's electronic trading, all those have a home inside Equinix. So a lot of our message, Paul, was yesterday was really about the opportunity that's in front of us. And Charles talked about, the size of the market opportunity. And we see it as roughly $140 billion opportunity, and we'll play inside that space. So it's an exciting time for us. And sort of the back end of the conversation was really about we're the best representative of a very strong financially strong company that has the balance sheet, has the liquidity, has the wherewithal to invest, to scale, where I think others are going to have a tougher time over the next little while.
And Keith, can you talk a little bit about what the growth looks like from your perspective in terms of top line, bottom line, and frankly, how that differentiates you from your data center peers, but also REITs broadly?
Yes. Well, the top line, what we told the market yesterday, we had our analyst day, and today's our 25th anniversary, interestingly enough. And so 25 years into our history, we basically told them, despite our scale and size today, that we can still grow the top line 8 to 10%. But I said there's accelerants to that we're not willing to share just yet. And one of them is AI and just the opportunity. And largely we said that because of it's in its infancy. The other aspect of it was really digital services. It's going to be an adjacency service for our customers. And again, it's just a little bit early. On the flip side, when we look at profitability, we said that we can grow AFFO per share 7 to 10%. And part of the reason we said 7 to 10%, as many people know, there's an element of refinancing that we have to do. And the cost of capital, of course, is larger today. But despite that, we also committed and suggested that we could spend $3 billion a year for the next 5 years. That's $15 billion. And the majority of it's going to be funded from internal resources. It means the cash flow in the business is fueling that growth, which I think is just a great opportunity, unparalleled compared to anyone else.
You're based in California. I wanted to get your view after we saw a lot of those regional banking stresses back in March, what your outlook is for growth and if you were impacted at all by that.
Yeah, Jess, obviously there was stress in the system. I think what it did was it created an environment where decisions were paused. And it caused people to stop and reflect on what really was happening within the financial segment. A large component of our business is certainly with the banking industry. A lot of the electronic trading takes place inside Equinix. That all said, the implications to us was very, very minor. And I say minor in the sense that we had Silicon Valley Bank, First Republic, and some of the others, but it wasn't a meaningful part of our revenue exposure.
And Keith, you mentioned just a minute ago the potential to spend $3 billion a year, $15 billion in total on CapEx. That's expanding your portfolio domestically, globally. Can you talk about the demand trends that is fueling the need for so much space and why you feel comfortable putting that much capital to work?
Yeah, well, right now we have 50 projects underway today of size in 37 markets in 25 countries. So it gives you a sense of the breadth of our business. One of the things I shared with the investors yesterday also was 75% of our revenues come from customers who want to operate in more than one region of the world. And so we're the best manifestation of that. So we draw comfort from, I think we have something that's very unique relative to the majority of the marketplace. Number two, all things digital feel like they should have a home in Equinix. And then number three, I suggest or posited that, with the difficulties in the marketplace, it feels like the supply over time is going to get constrained because cost of capital is high. It's harder to build. You have supply chain implications.
Access to power.
Access to power, access to water. These all would suggest that for the unsophisticated, it's going to be a harder build, and therefore we think we can fill that void. And in many ways, we even believe that pricing can move up favorably towards us. But the beauty is, look, I suggested $3 billion a year. We have levers. We can pull them as we see the information. We're making decisions, and our decisions are long-term based. You have to decide today what you're going to do years from now, and we can pull back on those if we need to.
So Keith, your CEO was just on the Death Star a little bit earlier, but we prefer to get the money guy in the studio here because you really pull the strings. I'm looking at your balance sheet here. I see about $15 billion of net debt. I see a little bit more than $3.5 billion of free cash flow. So you got some leverage on the balance sheet. Is it too much leverage? Is it optimal leverage? Where are you in terms of your balance sheet? And if you need to fund $15 billion, where's that coming from again?
Yeah, well, look, I'll tell you a few things. First and foremost, we're levered 3.4 times.
Okay.
When you look at an industry average at about 6.1 times.
Oh, okay.
So that's one. Number two, we have $2.6 billion of cash on our balance sheet.
That is correct.
We have a $4 billion unused line of credit. So I feel that we have the liquidity. But more than anything, the AFFO that we generate in the business, think of that as the cash flow, because it's after tax, after interest, after running the business and investing.
Jeff tried to teach me about AFFO. I'm not buying it.
Yeah,
But Paul loves dividends. Talk to Paul about dividends.
But think about, that's a $3 billion number or thereabout that's growing in the range of 7 to 10% per year. So number one, you've got the cash, and because of our structure, we only have to distribute out 42 cents of every dollar to the shareholders in the form of a dividend. And as a result, you're keeping 58 cents. And when you do that, and let's just use $3 billion for a simple number, times 60%, you get to keep $1.8 billion a year just to fund your growth. And of course, it's a growing number. So it's actually, the model works exceedingly well. So the dividend is going up, the investment is going up, but I think the opportunity is going up even more.
So if you have that cash, are you looking to acquire any particular companies to expand your network globally?
Jess, the answer is, look, we're always going to look at acquisitions. We've done 30 in our in our time, 30 plus. But the best use of our capital is actually investing in organic build. That's where we get the highest return. But we are expanding in the ASEAN countries. We want to be in other markets. So it's an exciting time. But I rather build organically than buy somebody.
All right, Keith, so glad to get some of your time here. Keith Taylor, CFO of Equinix, joining us, as well as Jeff Langbaum. He covers all the REITs, including Equinix for Bloomberg Intelligence. Right now, we're going to head back to Washington, D.C. Fed Chairman Jay Powell speaking in front of the Senate. Let's go back to D.C.
Actually, in this very room, I think, that you intended to, quote, consider appropriate ways to ease regulatory burdens for the banks. And when I asked you if there were any rules at all, that you thought ought to be made stronger, do you remember what you said?
I think I pointed to the net stable funding ratio.
No, actually, that's not what you said. You said, honestly, Senator, I think they're tough enough. You couldn't point to anything you thought should be tougher. In 2018...
In the event we strengthened the net stable funding ratio.
In 2018, you supported Congress's weakening of those rules. You led the Fed in hacking away at one rule after another. According to the Fed's own analysis of the Silicon Valley Bank failure, you weakened the rules in multiple ways. You reduced capital requirements. You weakened liquidity risk management. You skipped out on using enhanced stress testing for banks with tens of billions of dollars in assets and more. And the result was that the second, third, and fourth largest bank failures in U.S. history, which together required $23 billion in bailout money. In fact, you now hold the record. In a single year, the FDIC has been forced to rescue more giant failed banks on your watch than any Fed chair in American history. Chair Powell, do you agree with Vice Chair Barr's conclusion that the Fed bears a big share of the responsibility for the failure of SVB?
I certainly think that our supervision has been shown to have been lax in not being assertive enough. I think that the supervisors saw the right issues but weren't forceful enough in hindsight. And I think that's certainly a fair conclusion.
Okay. So those regulations were weakened. Those supervisors were clearly asleep at the switch for more than 5 years under your watch. And I'll just say it again. This is exactly why I opposed your nomination in 2017. The decisions that you made, the votes that you took, and the things that you said helped caused this mess. And when you were up for reappointment in 2021, I opposed your confirmation because I believed that your continued leadership would be dangerous to our financial system. And the Fed's own report confirms that. So yesterday, Chair Powell, this committee voted on a bill to help hold CEOs accountable when their actions blow up banks. At the Fed, you are the one who lobbied, who drafted, and who voted for weaker rules, and you were ultimately responsible for the team of Fed supervisors who fell down on the job. Do you take responsibility for your role in these bank failures?
So I think we learned some lessons from the bank failures, and the main responsibility I take is to learn the right lessons from this and to undertake to address them, so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system. That's not supposed to happen, and we need to take appropriate steps to make sure it doesn't happen again.
So I just want to make sure I understand what you mean when you say you take responsibility. Do you take responsibility for your actions that led to the failures of these banks?
Yeah, I think the question of what happened, supervision was at fault. That's both at the board and at the reserve banks.
And are you ultimately responsible for those supervisors? Are you in charge here?
Under the law, the vice chair for supervision has
Okay, so you take no
authority.
responsibility on
I didn't say that.
Well, that's what I'm trying to ask. I'm trying to understand what you take responsibility for.
I take responsibility for addressing the situation appropriately.
That's talking about going forward.
That's my focus. It's going forward.
Yeah, well, that kind of sounds like not taking responsibility for what you've done in the past. You know, a month ago, we had the CEOs of the banks that exploded in here, and each of them had scooped up huge bonuses, and each of them said they plan to keep every penny of that money. And now we have the chair of the Federal Reserve who led the charge to weaken bank regulations, who oversaw the bank supervisors who failed miserably to hold these banks in line. And again, the accountability is zero. Our banking system is broken. $23 billion in bailout money, and there is no accountability for those at the top. And once again, the people who didn't cause the mess are forced to clean it up. We need significant changes here. Mr. Chairman, I yield.
There are two senators that might be online. Senator Sinema is recognized from Arizona if she's online.
All right, that was Fed Chairman Jay Powell. He is speaking in front of a Senate Banking Committee. He was speaking yesterday, of course, in front of the House. Today is the Senate, talking about a wide range of issues, including the health of the banking system. So we want to bring you some of that Q&A from Senator Warren and Fed Chairman Jay Powell. Right now, let's get a quick business flash. We'll do that with Charlie Pellet.
Hey, thank you very much. And here's what's going on. We've got the Dow lower, the S&P, NASDAQ. They are both higher right now. Treasury yields are climbing as Jay Powell reinforces the recent message of a raft of policymakers signaling the Federal Reserve is not done yet with its interest rate increases. S&P up 5 right now. That is a gain of about 0.1%. We've got the Dow down 26, down 0.1%. NASDAQ up 87, up 0.7%. The NASDAQ 100 index up now by 0.8%. Small cap shares are retreating today, with the Russell 2000 down by about 0.7%. 10-year yield 3.79%, but the 2-year 4.77%. Spot gold down $19 the ounce to $19.13, a drop of 1%. And West Texas Intermediate crude oil down 4.2%, $69.46 a barrel. One of the next big economic events for U.S. markets will be July 12th when we get the next reading on U.S. consumer prices. Steve Matthews covers the Federal Reserve for Bloomberg News, and he was a guest right here on Bloomberg Markets. And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Ford is getting a $9.2 billion loan to help the U.S. catch up with China's EV technology, all a part of the government's $394 billion Clean Energy Project initiative. Ford shares, they're down now by 1.9%. Again, recapping, stocks are trading mixed. To the S&P up 4 points, up 0.1%. 10-year yield 3.79%. The 2-year 4.78%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pello, thank you so much. We appreciate that. Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Jess, we want to pass along some information we're getting via a tweet from the U.S. Coast Guard Northeast Twitter account. It says a debris field was discovered within the search area by an ROV near the Titanic. Experts within the Unified Command are evaluating the information.
And the Coast Guard is supposed to hold a press briefing around 3 p.m. this afternoon. So that's when we're going to wait and see what other details we can get out of this, Paul.
All right, so we'll wait for that press briefing, 3 p.m. Wall Street time, for some more information on that developing story. Right now, let's get a look at these markets. Charlie was just reporting kind of a flattish when you look at the S&P 500. Abigail Doolittle joins us here in our Bloomberg Interactive Broker Studio. Abigail, what are you looking at in this market here at midday?
The fact that the S&P 500 is still barely moving, so investors clearly looking for some more information. Fed Chair Jay Powell reiterating the message that the Fed will be hiking more, perhaps 1 or 2 more hikes in 2023. I do not think that he has talked about the cuts that the market is pricing in for next year. And again, we were talking about this a couple hours ago. He's actually said that that could be a couple years out, although that language seemed a little bit sloppy in some ways. But nonetheless, the message is they're hiking. Yesterday, that was sending stocks a little bit lower, modestly lower, down 0.3%. The NASDAQ, I believe, was down more than 1%. But today, a reversal for the NASDAQ, up about 0.7%. The S&P 500 up just slightly right now. So perhaps we're going to put a halt to the 3-day slide that we've had. That said, we were talking about the technicals before. It's going to be that 10-day moving average. The S&P 500 still hugging. The RSI is still going down. I strongly believe that we're going to see the S&P 500 closer to 3,300. That would be quite a slide. 4,300 soon, and then potentially back toward 4,000, even below 4,000. But the question that I posed before is what could be the potential trigger for that kind of a slide?
One technical function I really like to look at, it's WEIB. I'm sure that's something that Abby probably uses a lot, but whenever you're able to see the percentage of members above those moving averages. So you had mentioned the 10-day, about 44% of those stocks in the S&P 500 above that 10-day moving average. And then moving over to the 200-day, it had been more than 60%. Now it's around 54%. But, I mean, what kind of stands out to you? Is it more of those shorter-term gauges, just given the rally that we've seen over the last few weeks?
Well, that's this is great, and thank you for introducing me to this function. I never knew about it. So yeah, I looked this up by hand, chart by chart, which in some ways I would continue to do. Like it's a lot to take in at once. I would say most folks on the street, in terms of the percentage above moving averages, they really see that 200-day moving average as critical.
Yeah.
And that it's 50% is kind of the line in the sand.
Right.
And I think we talked about this actually last week, or that it seemed like it was going
kind of the
higher.
Make or break. It was a little bit of 50%.
Yeah,
right.
but it looks like it was going to go higher, but then a little bit lower. Yeah, it is a quick way to see kind of everything.
I look at it every day. If it's all there.
Yeah, it gives it to you.
Happy to keep sharing this to everybody.
Yeah, you brought up a good point. You know, talking about raising rates, and again, Fed Chairman Powell was, the red headline, at least that went across to Bloomberg today, was 2 more rate hikes. Yet the market's kind of hanging in there. I'm wondering if the market's saying, all right, they're going to raise some rates some more, but if they start cutting rates, maybe I'm concerned about the economy.
Right.
So I'm not sure what the market's really looking for here, whether it's interest rates are moving this market or whether maybe the bigger concern is maybe the overall health of this economy. And the fact that they're talking about raising rates, that means this economy is still too hot.
I think the markets do not believe the Fed. I mean, and
Really?
that's been the case for quite some time. Although the funny thing is, last year the bond traders really got the Fed wrong, and the stocks did okay because they, were in this historic hiking cycle. So it made sense that stocks were coming down. Now it's a little bit of a reversal. I think that bonds are maybe performing as they're supposed to, but stocks for some reason aren't listening. And then to bring the economy question into that, I would say based on my read of the data, one of the ISMs for last month was a little bit borderline, but for the most part, it's pretty solid. In fact, we just had that existing home sales data come in earlier today, and it basically is log jammed because mortgage rates are high, so people aren't moving. But it was a little bit better than expected, and I would argue that the Fed's hiking cycle, that what they were really targeting was the housing boom. I mean, it was this crazy housing boom out of nowhere. I mean, in March or early April of 2020, you had told me that we're going to go into one of the biggest housing bubbles ever.
Yep.
I would have said no, but I think that that's really what the Fed is targeting. So I think today's housing data, if that housing data remains strong, and they are also talking about this unemployment conundrum, the fact that it's so attractive, but that's a conundrum for them in terms of a hot economy. So yeah, mixed messages.
It's interesting too when you bring up the housing data because the home builders, if you want to look at that group in the S&P 500, up about 37% this year.
A record high.
Right, they're on a record high. And then if you look at obviously semis and then transports holding support, it seems like clearly some of these more cyclical corners of the market holding up a lot better. So does that clearly bode well when you're talking about breadth in the market being confined to a handful of tech and growth stocks?
Yeah, great question. I mean, the breadth certainly still is not great, and you can see that quickly just pulling up the S&P 500 groups on the year, which shows it really consolidating to the mega cap techs. And then it's interesting that you're talking about the home builders here too. I think that's based on the conversations that I've had with investors and analysts in that space, that's a tell on rates. So that's kind of consistent with the market not believing the Fed, that we're not going to see that 30-year rate go above 7 or 8%. And the home builders have also managed well. But that said, is it worth a record high? I don't know. I think that investors are really gunning for any corner where they think that they can get some extra juice. And then the question is, does it reverse on itself? Especially this AI trade.
Maybe if you locked in those lower housing mortgage rates and then you're not moving, then home builders are forced to continue to try to keep building.
That's
because there's lack of inventory.
Yeah,
I've had a lot of portfolio managers talk about that.
I live in a neighborhood where at this time of the year, I would expect a lot of houses to be for sale. There's one. I mean, it's like truly the type of neighborhood where houses would be for sale, and and it's.
And in my neighborhood, the houses are still selling very quickly.
Yes, agreed.
So
agreed.
I'm back into the real estate market. So now I care about that salt.
The Sweeney compound.
The Sweeney compound at the Jersey
beach
Shore.
house.
All right, Abigail Doolittle, thank you so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg at television. We appreciate getting a few minutes of her time here. Want to talk about this economy. We want to talk about this Fed. We want to see where we're going here. And to do that, we have a welcome guest returning, Shevin Yeltsin, the Dean at the University of Rochester Business School, joining us live here in our Bloomberg Interactive Broker Studio. Shevin, so great to see you again. What do you make of this Federal Reserve? We've heard Fed Chairman Powell today in front of the Senate, yesterday in front of the House, and every other Fed president is speaking all over the place. This Fed seems pretty consistent about raising rates here.
Yes. He definitely wanted to signal that they're not pausing for good. I mean, even though they've paused for a bit and they might pause throughout the summer or something, but until that inflation figures come down to about 2% or somewhere close to it, they're not pausing for a long period of time. So that was quite a strong statement.
And also pointing out that at least 2 more rate increases, which is something James Bullard had already pointed to about a month ago, and that's been priced into their dot plots. What do you think it's going to take, and when do you think the next potential rate increase could be? Paul and I have been talking about this a lot this morning because there's not a ton of data between now and the next Fed meeting in late July.
I mean, one of the interesting things about his statement was he was saying, you know, monetary policy takes a little while to sort of percolate throughout the economy, and what we're really doing is kind of giving it a chance to percolate rather than what we're seeing is very strong data for us to stop the inflationary, you know, suppressing inflation. So I don't think much is going to come between now and then. It's just that they're going to look at some very micro data, very low frequency data to be able to tell whether, you know, if the economy is not plunging into any kind of major, you know, slowdown, I think they're going to continue to raise rates.
All right, smart people like you tell me about this long and variable lags of Fed policy. I mean, the Fed's raised its interest rate over 500 basis points within a year. Why don't we just stop and just see how it plays out over the next several months? Why do they feel the need to kind of keep talking very hawkishly about raising rates, do you think?
I think because they know that people are going to be making investment decisions and certainly pricing things into long term, and they don't want to signal that they're done. They want to leave a lot of kind of gray room for them to maneuver. I think that's part of it as well, because we're not there yet. We're not seeing inflation, especially core inflation, is still kind of high. And I think it really gives them an opportunity to be able to maneuver the economy in whatever way that they see fit at the time that the data arrives. I mean, this is not a perfect science, but nowhere near it, right? There's a lot of wait and see and feel the ground and feel the data and crunch the numbers and do another kind of, you know, projection. So I think what we're seeing is just really that kind of work being played out. But now we get to see that data very, very frequently ourselves, which we didn't used to do 20, 30 years ago.
I like to use the ECFC function in the terminal to kind of gauge where economists pulled by Bloomberg are gauging where the economy is headed. And coming into this year, as you know, a lot of economists were expecting that we would already be in a recession at this point. Now it continues to get pushed back, but it's more when you're looking at a quarter-over-quarter basis, not year-over-year. Now it's looking maybe toward the tail end of this year. What do you think, how do you square this away when you still see resilient consumer data versus the inflation backdrop and this whole coming into this year where everybody was telegraphing a recession that hasn't necessarily come to fruition just yet?
I would like to say that I was one of the very few economists who kept saying, and even on record in this show, that I actually thought that the economy had a lot of pockets of resilience, that a recession, you know, what we see where the recession, you know, signs, there's a lot in the expectations. But that's because we're also talking a lot about it. I mean, a lot of the news we receive are negative these days, from Ukraine to relations with China to a whole variety of things. A lot of the news that we receive are negative, so that's affecting expectations. But consumers are very resilient. And I don't think it's just that fiscal stimulus, but that fiscal stimulus had run its course a while ago. Our savings rates are down back to close to zero again. So it's not really people spending the money that they had been given, you know, 2 years ago during the pandemic. There's a lot of consumer resilience. There's a lot of resilience in the service market. Housing market is still doing relatively well. I mean, it's not what it was a year and a half ago. I think it's still really, really pessimistic to say that we're going to go into a recession. Labor market is very tight. We can't hire people fast enough, and we're losing people every day.
How about your students at the University of Rochester, the business school there? How are they doing in the job market?
They're doing really well. So one of the places that they go to typically is the tech market. So the tech market certainly has taken a hit. What we are seeing is a little bit of a slowdown in decision making. They're not pulling out of the market. They're not, you know, stopping interviews, but they are taking a little longer to extend or putting out the start dates further into the summer rather than a June start date, a September start date, or a little bit later. But we haven't really. Consulting is one of the areas where we do see actually a slowdown.
Okay.
What do you think the catalyst could really be to actually see growth slow more significantly? Because are we really headed for a recession, or is it just kind of a little bit more of a slower growth regime for the next few quarters?
It's really hard to, I mean, I know this is such an economist answer, but at the same time, you know, we're talking about the housing market slowing down. At the same time, inventory is really low.
Right.
You know, and at the same time, we know that the cost of building is going up. So people who want to build sooner rather than later, because we still have a lot of supply issues going on. At the same time, we have geopolitics, right? And then we have a very strong dollar. There's just so many mixed signals and mixed sort of information inflation coming through that it's really hard to make a very strong prediction. And that's why I think all of us are having a really hard time to pinpoint exactly what's going to happen and when it's going to happen. But I've been much more optimistic because the resilience is certainly there. I think if we see a labor market really tightness go away, that's when we're going to get worried.
Why are so many people overlooking some of these resilient pockets and still going toward more of this kind of gloom scenario?
Maybe it sells more.
Yeah.
I'm not sure. Gloom
Just
and
given
doom.
the backdrop of the Fed and obviously what we saw with decades high inflation.
Exactly. I mean, because typically, I think historically too, if you saw inflation and that kind of numbers in inflation almost close to sort of double digits, historically when we look back, those were followed by recessions.
And then also the Fed obviously not having the best track record when
Exactly.
it comes to, say, these soft type landing scenarios.
They have, absolutely. So I think looking back historically, people are right to assume that there is going to be some sort of a slowdown. But again, we're seeing a lot of growth in the service sector, at least sort of going towards back to the pandemic levels. We're seeing a lot of sort of consumer resilience and labor market resilience. And I'm not quite sure that firms are really holding on to labor because, there's a lot of talk about labor hoarding.
Right.
And it's certainly new, placements are just not getting the applications that we used to see pre-pandemic. So it's hard. It's hard to replace people.
Let's talk about Turkey.
Oh.
Central bank hikes policy rate to 15%. Lira drops to a record low. You're an expert on Turkey. I know just give us their 30,000-foot view. What's happening there?
I mean, it's a good sign that they're reversing the policy of low interest rates.
Okay.
This idea that low interest rates would curb inflation is diametrically opposed to anything that we know about how an economy works. So they have raised it, but not raised it fast or large enough. They now have a new finance minister along with a new central bank governor. So hopefully we'll see a little bit more orthodox policies coming out of it. The lira is it's now down to about $1 to 20 liras or so. Yep. Election, well, he's got another 5-year term, so there will be at least, we'll see how that pans out too. But Turkey, it's going to take a while before investors come back in.
I know there's been so many challenges in Turkey in terms of natural disasters and so on. How are the people doing?
They are, at least the people that I am in touch with, and they have a very negative outlook. Okay. They have a very negative outlook about they don't trust the inflation numbers. They don't really trust some of the numbers.
Yet they put Erdogan back in for another 5 years.
Yes, absolutely.
All right. You're our expert, so whenever you come in here, we got to get the latest on.
I wouldn't say it was a very fair election either. So,
right. Yep. We'll leave it there. All right. Shevin Yeltikin, thank you so much for joining us. Always appreciate getting your perspective. Shevin is the dean at the University of Rochester Business School. I'm a big fan of Rochester. They turn out a lot of good graduates there. I've hired a bunch myself back in the day, so some good stuff there. Looking at the markets here, not much happening. We're going to keep that theme going pretty well. The only action we're seeing out there is a little bit a lift in the NASDAQ. We have the NASDAQ up about 0.5%, 13,565 on your NASDAQ. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, it's bad news for Boeing. The company's largest supplier suspended production after union workers voted to strike despite reaching a tentative agreement last week. The stoppage at Spirit AeroSystems will likely disrupt Boeing's efforts to step up output of its 737 MAX jets. Bloomberg's Abigail Doolittle reports.
We're hoping to rejuice the growth. If you look at the financials on this company, because of some of the tragedies in 2018 and 2019, I believe, there are big declines. Revenue, on the other hand, has been growing. This year, it's modeled to be at 15.5%. But if they can't get the parts to make that cash cow plane, then there could be a real problem. So I think that that's what investors are really fretting over here. The stock on the year up a little bit less than 10%, so underperforming the S&P 500 at this point.
Thanks, Abigail. Boeing shares down now 2.5%, while Spirit AeroSystems shares are down more than 9%. Vice Media has a buyer after going bankrupt. A group including Fortress Investment is set to acquire the company for $225 million. Multiple bidders made offers, but sources tell the New York Times the group led by Fortress was the only one deemed qualified. The purchase requires approval from a bankruptcy judge. Float like a butterfly? Sting like a tweet? Elon Musk is challenging social media rival Mark Zuckerberg to a cage match in response to the Meta platform's plan to roll out a competing service. Musk tweeted, "I'm up for a cage match if he is." Zuckerberg then posted a screenshot of Musk's comments on Instagram with the reply, "Send me a location." I don't know, Jess, are you Team Musk or Mark?
Ooh, this is a tough one. Maybe
We'll debate it. We'll debate it later. More coming up after this.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We are looking at a mixed market midday here with the Dow down 59 points now, a drop just about of 0.2%. S&P 500 index higher by 2, little change there, up less than 0.1%. Nasdaq, the composite index, up 64, up by 0.5%. Treasury yields are climbing as Jay Powell reinforces the recent message of a raft of policymakers signaling the Federal Reserve is not done yet with its interest rate increases. Powell back on Capitol Hill today. In addition to repeating that more rate hikes will be needed to get inflation to cool, he also promised more oversight for mid-sized banks.
We are committed, and I am personally committed to learning the right lessons from what happened in Silicon Valley Bank and the other 2 failures, and vigorously implementing appropriately. I think there's a clear need to strengthen both supervision and regulation of banks of that size.
The Church of England Pensions Board will offload its stake in Shell as part of a total exit from oil and gas as the influential investor turns its back on companies it says are failing to address climate risks. Today, Shell shares down by just about 0.8%. 10-year yield now 3.79%, with the 2-year yield 4.77%. Spot gold down $16 the ounce. Right now, an ounce of the precious metal trading at $19.16, down 0.8%. And West Texas Intermediate crude back below $70 a barrel. WTI down 4.3% now, $69.40 a barrel on WTI. So again, recapping, equity markets are mixed. The Dow lower, S&P, NASDAQ higher. S&P up 3, a gain of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate that, as always. Jess Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio.
I'm really excited for our next guest. First time I've been able to meet him in person, but
right?
followed his work for years.
Oh, boy. This must be a treat for you. Barry Ritholtz, host of Masters in Business. I mean, for me, it's nothing, but it's just Barry. He's host of Masters in Business. I think he runs some money, too. He's a chairman and chief investment officer of Ritholtz Wealth Management. Hey, Barry, S&P 500, it's up 14% this year. Why don't I just index my money and just go onto the golf course?
I don't know. Why don't you?
I don't know. I mean, why am I sitting here wasting trying to do research and all that kind of stuff? Just buy the index.
I mean, at the very least, having the core of your investment portfolio be an index, and then, I like to describe it as the Christmas tree and the ornaments. If your core is the S&P 500, you're never going to be that far off from the market. You'll, at the very least, compound at a pretty close to market rate. And then if you feel like you're enthusiastic about different things, maybe you like value, maybe you like technology, maybe you want to go regional and say, I think India is the next great growth region, or whatever it happens to be. I'm just randomly pulling examples out of the air. That's perfectly fine. You can absolutely start with the index, especially when you look at how easy it is to go out and buy an ETF, and the cost is 4 or 5 basis points. It's practically free. So for the average, home viewer listening at home, it's a great place to start.
And you had a column recently specifically about this and why indexing should be a part of investors' core investment strategy. What were these 5 issues? Can you walk us through when you were talking about this?
It's funny because there's sort of been a cottage industry trashing indexing. If you remember a couple of years ago, we heard it was un-American, it was anti-competitive. When Jack Bogle and Vanguard first launched in '74, they were told it was literally communistic. The advantage, so let's start out first and foremost, costs. And while the active side has gotten much better on costs, used to be about 200 basis points for the average active mutual fund. That's now somewhere between, let's call it 50 and 75 basis points. It's not 4 bips, it's appreciably higher. Over 30 years, if you're going to compound with fees of 75 basis points just for the funds, say nothing about the advice or trading or taxes or anything like that, that's going to end up being about 20% of your total returns. It really has a giant impact. So costs are a big part of it. Second of the 5 things is simply behavior. If you're just buying an index, you're not engaging in stock selection, you're not market timing, you're not jumping in and out, you're not thinking about all the things that lead human beings to make bad investment decisions. It turns out people are full of cognitive errors and behavioral biases, and it leads us to places that not the greatest when it comes to making investing. I mentioned stock selection, which you don't do. That's the third thing. There have been a number of studies. Hendrik Bessenminder is probably the most famous of the studies. Most stocks don't really do anything. Some stocks go up a little, some stocks go down a little, a couple really crash and burn. But it turns out the market indexes are primarily driven by the big winners, and that's 1.5% of the total stocks. So not only do you have to find that needle in a haystack, you also have to avoid all the rest of the meh stocks. Really, really hard. When you buy an index like the S&P 500 that's cap weighted, not only are you pretty much guaranteed to have those winners in them, but as they get bigger, you own more of them. The Apple is the largest component in the S&P 500. It's also the biggest U.S. company in the world, and what a surprise. It used to be a tiny percentage of the S&P 500 in the 90s, and now it's large. And then the last couple of things are really, I don't know, a little picayune, but those 3 are the way you can start from.
Yep. Hey, Barry, when I started out in the business, we went to the mutual funds because that's where all the money was. As a sell-side analyst, I'd go to Boston 3 or 4 times a year, walk around town, seeing Fidelity and Putnam and all those, because that's where the money was. Now I'm asking my question, is there any future for the mutual fund business? ETFs is gobbling up all the money. I've got mutual funds converting to ETFs. It's a race to the bottom on costs. What's the future of the mutual fund business, do you think?
So the single biggest advantage of ETFs is that there's no phantom capital gains tax. Maybe this is a little controversial, this is my opinion, but it's hard to argue that if I own a mutual fund and I don't sell it, right, I continue to hold it, but there are sales and transactions within, and people who own that fund buy it or sell it. Suddenly I get a tax bill. That's terrible. So I could understand why in taxable accounts there's a built-in preference for ETFs. However, the mutual fund structure is well known, it's well understood. In many ways, it scales very nicely, whereas you have some issues with ETFs scaling. So in qualified tax accounts and in IRAs and 401ks, of course you want to go with a mutual fund. They don't trade during the day, so there's none of that headache. You get priced daily. That's all you really need. The costs have come down dramatically, and your biggest concern is that phantom tax. That goes away in a 401k or an IRA. So I think the future of mutual funds is going to be in those retirement accounts. Yeah, ETFs give you some thematics, they give you some indexes, they give you some other things that work better in the non-tax exempt accounts. There's room for both of them. They each serve a different role.
Money market mutual funds have been such a hot topic, especially given just with investors being able to yield more. And last week, actually, the Investment Company Institute showed how there were flows coming out of that for the first time in about 2 months. I'm wondering, what's the catalyst to push more of the cash that's sitting there into the equity market?
That's always a key question. I mean, the amazing thing is, you know, you got zero in money market funds and practically nothing in bonds for a long time. Wait, I could put money in a money market fund and get 5.5% pretty safely. I mean, as long as it's a name brand that you don't have to worry about it somehow being tied to some stable coin that blows up. But like, if you want a Vanguard or a Fidelity or a Franklin Templeton money market fund, you're going to get 5%. That's pretty safe money. If I'm going to rotate some of that into the equity market, there really has to be a promise or an expected return appreciably higher than 5%, and you know, up 14% for the year, halfway through the year. That's a good year.
Yep.
Right.
You know, the equity market could, you know, all right, gone fishing and take the rest of the year off, and it's a good year. Not that that's going to happen unless Jerome Powell goes fishing and takes the rest of the year off, and then we're off to the races.
Yeah, NASDAQ 100 is off to its best first 6 months to a year ever, actually.
To be fair, it's coming off a horrific year.
Right, very painful last year.
But by the way, people don't think this way, but NASDAQ down 30%, I'm absolutely a buyer anytime. Maybe not the whole position, maybe you're waiting to see if you're down 40% or more, but anytime you have that sort of a sell-off in that rapid a period of time, you have to think, hey, this has fallen so far out of favor that the valuations have become attractive.
30 seconds, Balance Power, Masters in Business. Who do you got coming up?
So coming up in 2 weeks, I have Jenny Johnson of Franklin Templeton. Next week is going to be Alana Weinstein, one of the hedge fund hunter, and this weekend Peter Borish, Paul Tudor Jones' partner, and runs the Robinhood Foundation.
You got players every Tuesday when he does his recording here in our
studio. A lot of fun.
I kind of just make sure I kind of walk by the studio to see who's
just
there.
To see who's there.
It's kind of like stargazing. Barry Ritholtz, he's host of Masters in Business, a fantastic podcast. Check it out. He also is a chairman and chief investment officer of Ritholtz Wealth Management. Love getting him here, and it's good to get him in studio. Better than the phone, so we appreciate him coming in here. It's good stuff. Right now, let's head down to Washington D.C. We're going to get world and national news, and we're going to do that with Nancy Lyons.
Thanks, Paul. The Coast Guard says it has found a debris field near the Titanic, which could be a missing submersible. Experts with the team leading the search are evaluating the new information. We're expecting an update from the Coast Guard at 3 p.m. Wall Street time, which we will carry live here on Bloomberg Radio. 5 people were on the Titan submersible when it went missing Sunday, just a short time after submerging for a trip to the Titanic wreckage. Indian Prime Minister Narendra Modi is in the U.S. on his first official state visit. It's a high-profile affair with a banquet at the White House and an address to Congress. President Biden says the two nations share a commitment to freedom.
I've long believed that the relationship between the United States and India is will be one of the defining relationships of the 21st century.
Biden and Modi are expected to strike some commercial deals during their discussions. Wall Street Journal reporter Evan Gershkovich, who has been detained and accused of espionage in Russia, will be spending more time behind bars. Today, his latest appeal was rejected. U.S. Ambassador to Russia, Lynn Tracy, spoke to reporters after today's hearing.
This was a procedural hearing appealing the conditions of his continued detention, and we were extremely disappointed by the denial of his appeal.
Ambassador Tracy says Gershkovich is innocent and wrongfully detained. The field for the 2024 GOP presidential nomination continues to grow. Former Texas Congressman Will Hurd announced his bid this morning. Hurd is a former CIA officer who served in Congress from 2015 to 2021. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
News, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and 38 points. 10-year yield 3.79%, with the 2-year 4.78%. Gold down $15 the ounce, now down 4.4%, $69.31 a barrel. Treasury yields climbed as Fed Chair Jay Powell reinforced the recent message of a raft of policymakers signaling the Federal Reserve is not done yet with its interest rate increases. The index of leading economic indicators, a gauge of the U.S. outlook, continues to fall. The Conference Board's index has been declining since April of 2022. Dana Peterson is the board's chief economist, and she was interviewed right here on Bloomberg Markets.
Absolutely. So the leading economic indicator fell again for, I think, the 14th consecutive month. And the weakness was definitely in expectations from the ISM in terms of manufacturing and also from consumers. And then the yield curve continued to be negative. And also the leading credit indicator was negative. So that's all telling us that there's still some weakness out there. There's still expectation that maybe we'll go into a recession. Certainly it's...
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Boeing's biggest supplier, Spirit AeroSystems Holdings, has suspended production after union workers voted to strike. Again, recapping, stocks are mixed. The Dow lower, S&P higher by 5, up by 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate that. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. You know, Jess, earlier this month I was at BNY Mellon's Insight Conference down in Orlando.
That's right.
And they bring a lot of financial advisors there. And a lot of the financial advisors were saying their clients want more access or more exposure, I guess, to alternative investments. And, you know, they were talking about private equity, you know, private debt, digital hedge funds, all that kind of stuff. So really interesting to me that it's not just an institutional product, but a lot of retail folks want to get access to it as well. So our next guest is very timely. Claire Van Wyck Allen, Managing Director and Head of Canada for AIMA. And AIMA is a global association for hedge funds, private credit, and digital assets. Claire, thanks so much for joining us here. Alternative investments here. Give us a lay of the land about how the flow of funds have been into just, you know, alternatives, just generally speaking, over the last several years.
Thank you so much for having me. And as you noted, AIMA is a global association representing primarily the hedge fund, private credit, and now digital asset industries. Though generally, alternative investments across the board are expected to nearly double in AUM by 2027, with 23 trillion expected to be allocated across all alternative asset classes. And in your opening remarks, you noted the interest from retail. That's certainly a trend that has persisted here in Canada, where we've always had a very robust wealth management channel interested in alternatives. But that has only heightened over the last couple of years, and we've seen increased flows across particularly private market investments, private equity in particular, private credit to name a second, infrastructure and real estate. At least in the Canadian context, the advent of liquid alts, where we've seen the hedge fund structure now be able to be offered in a more liquid format, similar to what you have in the U.S. With alternative 40 Act funds.
Claire, talk to us about the private credit business. It's been an area that's attracted a tremendous amount of capital over the last decade, I would say. I mean, most people know about private equity, but less so about private credit. What are you seeing in terms of that part of the market?
We're hearing across the board that a lot of institutions are planning to double, in some cases, their allocations to private credit. The latest stats from Preqin show that 30% of institutions are allocating to private credit with an average allocation of 6.2%. And a lot of the drive behind this increase of interest in private credit is that we've seen that bank retrenchment, obviously made only worse by regulation, but also situations like the collapse of SVB, and then, of course, following on with First Republic. And there's a lot of concern generally that there may be further issues with regional banks in the U.S. and obviously capital provided by private credit lenders are key funding mechanisms from a cash flow perspective, funding M&A transactions, and just general working capital. I think an interesting stat in private credit is many of the borrowers oftentimes are working with firms or organizations that they know really well, with 40% of loans being to repeat borrowers.
Since we're almost halfway through this year, what do you think is in store for the hedge fund industry for the second half of 2023?
We would expect it to grow. We're hearing from institutional allocators that, again, they are looking to grow their allocations in hedge funds given the current market conditions. Recent data from Preqin, 37% of institutions are allocating to hedge funds with an average allocation of 12.2%. And some of the recent sub-strategies within hedge funds that seem to be really of interest include multi-strategy, global macro, long-short credit, and distressed opportunities. And of course, as we continue to see the markets march on and whether we hit a recession or not, there's certainly a lot more stress within some companies. And so there is a lot of expectation that default rates will slowly rise and increase in bankruptcies, and there may be more distressed opportunities, both in the hedge fund and private credit space.
Hey, Claire, just about a minute left. Do you have any concerns that the private equity market does not mark its positions as frequently as it should?
We absolutely believe that they are marked at a reasonable rate. Again, stability is an intentional feature of private equity, and GPs in particular know their businesses really, really well. Many GPs, of course, are engaging with third-party valuation firms. Institutional allocators are demanding a lot of questions and providing oversight, and on their side too, potentially third-party valuations of private equity holdings. Generally, what we've heard across the board, both at conferences and in our allocator-only peer groups, are that private equity valuations are generally fairly valued in this market. Though again, slight concerns about, as the market and potential recession may loom, something that they're watching really closely, and they're slowing the pace of further commitments, given that they're faced with the denominator effect already.
All right, Claire, thanks so much for joining us. Really appreciate getting your thoughts there. Claire Van Wyck Allen, Managing Director, Head of Canada for AIMA. AIMA is a global association for hedge funds, private credit, and digital assets. So we're looking at these markets right here, pretty much unchanged for the S&P 500. All right, we're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Amazon's cloud unit is building a program to help customers develop and deploy new kinds of artificial intelligence products, as the biggest seller of cloud services tries to match Microsoft and Google in the market for so-called generative AI. Amazon Web Services is investing $100 million in the project. The company unveiled its own generative AI tools earlier this year. We reported in May that Amazon employees and customers thought the announcement was uncharacteristically vague. Deutsche Bank's boss sees a recovery for fixed income trading on the horizon. That's after warning last week of a 15 to 20% drop in trading for the current quarter. CEO Christian Saving tells Bloomberg that he pledges to increase revenue and profitability following a turnaround that included thousands of job cuts and an exit from equities trading. Ford and its battery manufacturing partner will receive a $9.2 billion loan from the U.S. government to build its electric battery factories in Kentucky and Tennessee. The conditional loan is the biggest government backing of an American automaker since bailouts during the 2009 financial crisis. Ford aims to crank out as many as 2 million electric vehicles by the year 2026. Warren Buffett takes stock in the importance of generosity. Buffett has donated roughly $4.6 billion in Berkshire Hathaway shares to 5 charities, and that includes the Bill and Melinda Gates Foundation. The 92-year-old has said that he will provide more than 99% of his estate to be used for philanthropic causes. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up next.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Looking at these markets here, very quiet day. S&P pretty much unchanged. Yields moving definitely on the higher side, 7 basis points, both on the 2-year and the 10-year Treasuries. The 10-year's at 3.79%. A big pullback in WTI crude oil, off almost 5%. We're now below $69, $68.97 there. So it tried to rally a little bit over the past couple of days, but giving it all back here. Definitely some concerns out there about global demand. Right now, let's head down to Washington, D.C. We're going to get world and national news with Nancy Lyons.
Thanks, Paul. We are expecting to hear from the Coast Guard this afternoon on the status of the search for the Titan submersible lost somewhere near the wreckage of the Titanic. A remotely operated underwater vehicle, or ROV, has found a field of debris near the wreck of the Titanic, where the search was focused. The Titan lost contact with the surface ship shortly after departing Sunday for an expedition to the wreckage. A news conference is set for 3 o'clock this afternoon, Wall Street time. You can listen live here on Bloomberg Radio. President Biden is welcoming Prime Minister Narendra Modi of India to the White House for an official state visit. While speaking from the South Lawn this morning, Biden said the challenges of the 21st century will require cooperation.
Challenges and opportunities facing the world in this century require that India and the United States work and lead together. And we are.
For Biden, India offers a diplomatic and military counterbalance to China's power in the region, and his visit comes at a time when the U.S. is distancing itself from its biggest trade partner and the world's manufacturing powerhouse. Well, it took hours of debate that went into the wee hours of this morning, but a House panel has approved the annual defense authorization bill. We get more on that from Bloomberg's Amy Morris.
The debate focused on Republican social priorities, including efforts to eliminate critical race theory and curb diversity and equity programs. Democrats pushed back, but in the end, the House Armed Services Committee approved the measure. The full House will take up the measure early next month to authorize $886 billion for national security programs, $11.8 billion of which is for defense-related activities other than national defense. The Senate is also considering it. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
All right, Nancy Lyons, thank you so much. We appreciate it. One of the concerns that I think bears have in this marketplace, they're saying, there's no breadth to this market. It's just the Magnificent Seven stocks, the big cap stocks that are driving this market. But you've got some reporting that says maybe something a little bit different there.
A little bit different. I did the taking stock column today. So I was looking at how 2 of the 3 most economically sensitive industries in the stock market, when you're thinking about semis, obviously been on a tear this year, trading at records, but then also home builders. And then a third key group, when you're looking at what transports are doing, those have broken out, trading above those support levels, breaking out of its downtrend. So you're seeing not just transports, but overall with the industrial sector, that also trading near records, in addition to what we've seen with small caps this month when you're looking at the Russell 2000 on a tear as well. So now specifically in June, you're starting to see that rotation broaden out to these sectors and industries that are obviously more tied closely to the economy. This is something that investors wanted to see. Obviously, we'll have to see how long this continues, but this kind of counters that argument and throws a little bit cold water on it when you are arguing about breadth being a bit too narrow, Paul.
Yeah, you've got this great chart in there. I like pretty pictures because it's easy for you to understand. But just so far in the month of June, this is where we've seen a lot of the breadth kind of improve. But the best performers, consumer discretionary up 8.8% in the month. Industrials up 8.6%. Materials up 7.7%. So those are some of the sectors that, you kind of think that, that's betting on a better economy down the road.
Exactly. Brighter times ahead. And so we need to see if this can continue.
Yeah, that's all in the face of what we heard from central bankers around the world over the last couple of weeks, that inflation is still the #1 issue for monetary policy. And that's why we're going to see continued bullish or hawkish talk coming out of most of these central bankers, and that's including Jay Powell today testifying in front of the Senate, where again kind of suggested 2 more rate hikes in the plans for the year. Coming up, Sound On with Joe Matthew. That starts right now.
Including the divisive politics around gender identity, the 2020 election, and the 2024 presidential election. We'll be talking about all of that and more. Stay tuned. We'll be right back.
Including the divisive politics around gender identity, the 2020 election, and the 2024 presidential election.
and fair access to capital.
And today, that's where we start, Romain. Access to capital over the past year. Look, the global economic landscape has changed. Aftershocks from the pandemic, from the war in Ukraine, rising interest rates, the recent turmoil in the banking sector here in the US, all flashed those warning signals for global lenders. Now, while the latest Fed lending data has started to stabilize, back in March, US bank lending contracts, they contracted by the most on record, seeing a drop of more than $105 billion. That's, of course, amid the collapse of several lenders, including Silicon Valley Bank. Now, tightening credit conditions signal the end of cheap money, and, well, we've been used to that in years past. So what does it mean? What does this mean for the financing gap that's already faced by developing nations, by diverse startup founders, by small business owners, who have often been shut out of paths to capital, Romain? It's the key question of, it's getting harder for people who are already finding it hard.
That's exactly the point here. We've talked so much over the past few years about how you broaden, how you diversify sort of the startup environment, the VC environment. But of course, ultimately, it still comes down to not just interest and not just effort, but also the money as well here. You take a look at the data behind me when you talk about the number of minority-owned firms, and you put that up against the number of firms out there by non-minorities, you can see the differential there. We're still only about maybe, what, a quarter, barely a quarter of the total amount there. That's at least based on what the current census data out there, Caroline. And in order to close that gap, it's got to be about more than just wanting to close the gap. That money, it's got to flow into it as well.
And not only into large businesses, small businesses too. We can dive right in there with Eric Taylor, CEO of Trident. It's a private equity firm focused on acquiring US-based small businesses, an emphasis on leveraging diversity, equity, and inclusion as a competitive advantage. So Eric, how, when you identify a company that is ripe for your help, do you ensure that you instill that within the focus of the business?
Sure. So first of all, thank you so much for having me on, guys. Really excited to be here. At Trident, we focus on small businesses because we think it's incredibly underpenetrated by the asset management industry at large. And there's really two things that we're doing that we think is a little bit different. The first is incorporating technology to begin to eliminate some of the systemic biases that people tend to see in underwriting. That means that we're thinking about who our operators are. We're thinking about diversity of our management teams. We're thinking about actual diversity of the underlying owners of these businesses. And given the entire purpose of what we're doing is buying and building family-owned small businesses, incorporating diversity into that literal algorithm ensures that we're actually smoothing out some of those racial biases. And you know, what that means at the end of the day is that our investing dollars are going into places that we think are A, underpenetrated, B, able to create more value, and C, obviously, more diverse.
Talk to us about the creating value, because that's for many. Yes, there was this moment of, well, reckoning back in 2020. People knew what the moral and right thing was to do, but ultimately to solve these things, you need to show that it makes good business sense as well. How have you shown that in terms of profitability, for example? How does it work?
Well, A, I think it helps when you are investing in an asset class that is naturally underpenetrated and you know, relatively devoid of competition. So that's sort of where we start. We generally don't tend to see other big asset managers playing in the same sandbox, where we are. And so as a result, we find opportunities that others don't. But you specifically asked about post-investment value creation, so you know, I mentioned that. When we think about how we build businesses post-transaction, we incorporate a number of techniques that mean that the suppliers that we're using are diverse. It means that we're putting capital in Black-owned banks. It means that when we're bringing in new members of the C-suite, we've got sort of diversity checkpoints that we're using. It means that consultants that we're bringing in to help us build businesses are diverse. And so you end up with a more diverse business. You end up with a business that's actually creating more value because we're bringing in institutional quality techniques to actually build those companies. And so it's a win-win for both.
Talk about the raising of capital, though, and where this money is going to come from. When we talk about closing the gap and addressing some of the issues that you just pointed out, at the end of the day, you still need those millions, those billions, really, to flow.
Totally. You have trillions, really, if you think about it. As we've thought about this sort of gap in access to capital, I think there's really four places where capital tends to come from and flow. So first is public funds. You saw that during the pandemic, the National Bureau of Economic Research effectively published that blacks had not the same access to PPP loans from small and mid-sized banks, and they actually said that the reason was subjective in nature. So public funds. Then on to bank credit. Right. The Milken Institute said that over 70% of U.S. Census tracts that are minority don't even have bank branches. And so if you think about the legacy of credit in this country, if you're black, brown, or female, it's typically harder for you to get access to credit. Third is VC funding. We know that less than 2% of VC funding tends to go to black, brown, and women-owned businesses. And so that's a problem. Now, we can't fix all of those problems.
You can't fix all of those, but I just want to stop you there because you used the word subjective in terms of PPP loans, and we've seen this in other areas too when it comes to raising capital. How do you apply sort of something that is systematic, something that is data-driven to a problem that is often subjective?
Well, I think first of all, you have to look at the root of it. When I say subjective, I'm talking about natural biases that people have, right? And I think when you're thinking about building businesses or where to allocate capital, people have in their minds sort of what they're used to, where capital should go. When in fact, when you think about underwriting, usually you're thinking about financial data. When you think about mortgages, you're thinking about appraisals or credit scores. When you're thinking about business loans, you're thinking about cash flow or asset value. And so it's trying to make sure that in your underwriting and in your analysis, those numbers are coming up to the top, as opposed to someone's personal view on who they're lending or who they're investing in. And I think over time, what we're really seeing is that it's not just in the underwriting, but it's in who's doing the underwriting. To the extent that folks have more diverse organizations, we can see that when it comes to allocators, when it comes to asset managers, when it comes to banks, you're actually seeing better results, not only economically, but also from a diverse perspective.
All right, a great conversation, Eric, and I think we have to continue this another time. Eric Taylor there, he's the CEO over at Trident, a private equity firm focused here on acquiring small businesses, of course, with the focus on minorities. We're going to continue this conversation because, as we mentioned, we talk about how the landscape has changed over the past few years. A social reckoning that Caroline was just talking about back in 2020, it caused a lot of venture capitalists to rethink where they funneled their money. That led to more capital reaching diverse founders. That's a good thing. But a survey out by Morgan Stanley shows that progress stalling. Our next guest is a co-founder of a startup and sees VC funding as a way to help close the persistent wealth gaps. Angel Wang is Chief Growth Officer over at Anise Health, and she joins us right now. Angel, let's start here about closing that gap through the power of money and, more importantly, through the power of funding these businesses.
Absolutely. I'm a woman of color in the founding team of Startup, and all of the discrimination and bias that Eric talked about are things that our founding team faced during our fundraising challenge. A lot of that subjectivity comes because in early stage venture capital investing, you're trying to de-risk your choice by relying on intangible qualities such as, do I trust the team? Do I think they're going to win in the market? Do they look like the types of entrepreneurs that I have believed have won before? And as long as we can expand our definition of what a successful entrepreneur looks like, we can allow those entrepreneurs to thrive as well.
Well, let's talk about what a successful entrepreneur looks like, Angel. There's been a lot of talk about the racial reckoning out of 2020, a racial reckoning that largely did center around African Americans. We know that the outgrowth of that, though, was also a lot of people saying, don't forget about some of the other minority groups in this country who are dealing with a lot of the same issues.
There was an over 300% increase in anti-Asian violence during the pandemic. In fact, this is also catalyzed with the fact that Asian Americans experience the highest rate of income inequality out of all ethnic groups. Over the past few decades, the income inequality gap between the top decile of Asian Americans have increased 77% more than the bottom decile. And the Asian immigrant population is expected to double within the next 2 decades. So the fact that this wealth gap is going to be exacerbated is something that we need to address right now.
Angel, you did do a pre-seed round, 1.2 million, I think it was, raised June 2023. Kicker Ventures involved, we've had Gold House Ventures as well, Alston, but these aren't quote-unquote household angel investing names, and I'm interested in whether things are changing, whether we are seeing more and more VCs come in showing that they can write checks to the right company with their own diverse backing, but also whether some of the age-old names in VC are doing the same thing too.
Yes, absolutely. We find that the funder-founder fit is extremely important. For us, when we were conducting interviews with investors, we found that the bar to which we were compared was higher. We had to work stronger, faster, smarter, just to get early traction. And we actually partnered with Goldhouse Ventures through their accelerator program, where they provided dedicated mentoring and coaching so that we learned the invisible rules of the game. What's important to highlight here, though, is with these diverse funds who are looking for those entrepreneurs who have asymmetric information on the market, it's important to know that minority founders are often over-mentored and undercapitalized. So while coaching is important, it needs to be followed with checks, because you can't start a strong organization without funding.
Do you have optimism those checks are going to come?
Yes, we actually have secured $1.2 million in our pre-seed. We're open to additional investor conversations.
But not just you, Angel, because I mentioned how you've successfully raised pre-seed. But more generally, are you confident that checks will flow to diverse founders?
It requires a multifaceted approach where we need to increase the diversity of investors, we need to increase the types of businesses that are being founded, and we need to recognize that we all serve to benefit while we do these methods, because innovation drives economic growth, and as long as we can empower minority founders to drive the innovation, we all serve to benefit.
Well said, Angel Wang. Thank you so much for spending time with us, Head of Growth at Denise Health. Meanwhile, coming up on Bloomberg Equality, look, world leaders, they've gathered in Paris as French President Macron seeks to build support for an overhaul of global lending architecture. We're going to discuss the push for better capital access for developing nations, not just diverse founders here in the United States. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We want to provide all the financial means for those countries to be efficient in the fight against poverty and in the fight against climate change. This is the key purpose of this summit, and I think that the key point, the key purpose would be to define a new financial architecture.
Recognize that the world cannot continue in the shadow of an old imperial order that does not see countries, does not feel countries, does not hear countries, and worse, does not see, feel, or hear people. I ask us today to recognize that we cannot come to Paris, but let our directors go back to the IMF or the World Bank and it be business as usual.
I see great urgency in bringing the IMF's concessional window, the Poverty Reduction and Growth Trust, to a more financially sustainable footing. This is critical to make sure lower-income countries have adequate resources at the fund.
There's no way that there's adequate money in the governments or philanthropy or the multilateral banks. You have to bring in the ingenuity and the capital and the technology of the private sector. That's what we're trying to harness, but doing it in a way that brings people who know the private sector, understand its risks and management, and those people come to help us do things better.
This is Bloomberg Equality. And of course, leaders from Macron's summit for a new global financing pact is underway in Paris, weighing in on the importance of supporting the flow of capital to developing nations. Let's just dig in a little bit for a moment, Romain, at what is trying to be achieved here. This has been like a new financing construct, a revamp of Bretton Woods. We heard from the leader of Barbados, Mia Mottley, actually the driving force behind this, and chief behind her was Macron, really trying to bring people together to better support poorer nations, particularly give them debt relief when catastrophes happen, often catastrophes driven by climate change. And